and good morning, good afternoon, and good evening, everyone. And welcome to this second day of public consultation. Again, also today will be unfortunately on virtual mode. Today, the consultation is focused on the Pillar 2 blueprint after the yesterday consultation on Pillar 1. And this consultation follows the release of the blueprint on Pillar 2, which has been done on last 12 October and open for written consultation. And today it's the opportunity for having a virtual and a direct consultation. This public consultation also builds on the earlier public consultation we had some times ago. Now it was in December 2019, and that consultation was focused on certain aspects of the global anti-base erosion rules, the so-called global rules, and in particular, the focus of the first consultation was on particular aspects like the use of financial accounts to determine income, adjustment for permanent differences, and mechanisms to address timing differences, blending, and carve-outs. Indeed, after the first consultation that was held in December 2019, changes and refinement has been made, and then in the final blueprints taking also into account inputs that came from the stakeholders. So the blueprint on Pillar 2 completes also the package of measures on Pillar 2 by providing details on the rules for the allocation of top-up tax under the income inclusion rules and under the under-tax payment rule, and also options for the design of the subject to tax rules. This second public consultation on GLOBE provides the opportunity for the stakeholder to give inputs on all the aspects of the Pillar 2 proposal. And for the public consultation, has been identified some specific question to be addressed by the stakeholders, and a key focus of the consultation was on simplification measures, and a number of commentators submitted comments and observations on this specific issues. Indeed, the members of the Inclusive Framework are grateful for the detailed submission, and also of the wideness of the submission came from the business advisors, civil society, and academy. Indeed, in today, it's not possible to go go through and review separately all the aspects of the Pillar 2, and which were also the basis of the consultation. But rather, the purpose of the day is to provide an overview and that highlights some of the key issues of the that emerged in the submission of the public consultation. Like yesterday for the public consultation on Pillar 1, we will start with a presentation by the Secretariat. I think it will be Hakim and John that will present shortly the submission, an overview or a short overview of the submission, and then the discussion will be structured and articulated on two panels, moderated by Hakim, the first one, and John, the second one. And the first panel will be focused on tax base and simplification options, and the second will address some of the selected issues from the consultation. More or less, the time allotted for the two panels will be 1 hour and 15 minutes for both. And after the panels, Pascal Saint-Amand, director of the Center for Tax Policy Administration, will recap this discussion, this conversation in the two days of consultation. So with this, I would suggest we go to the Secretariat. I think it's Hakim to give an overview of the submission and the consultation process.
Thank you, Marco, and welcome everybody back to Day 2 of our two-pillar session. So thank you for having submitted, and thank you for listening in, and sort of in advance already thank you to all the speakers that will be participating in the panel. Like yesterday, we have tried, perhaps failed, but at least tried to give you a summary of what we understand the broad themes are that are coming out of the submissions. Like yesterday, we have a PowerPoint. We're going to take you in about 15 minutes roughly through what we understood to be the big themes to be, recognizing, of course, that any summary is inherently not fully accurate, but we're trying our best to just give you a flavor. And of course, all of these comments are available on our websites if you want to read what other submitters have sent in. So if we can bring up the slides, I see them here emerging, then I will do the beginning of the slides here and just give you a bit of a flavor. Starting with the next slide, which gives you, like we did in Pillar 1, a bit of a breakdown roughly of the submissions that have come in. So, we shouldn't necessarily judge it by the lengths. Sometimes if you have more time, you make it shorter, it might be more succinct, but just to give you a sense, we have about, similar to Pillar 1, about 1,800 pages, around 200 submissions. We've also tried to do a breakdown into, the different stakeholder groups that have contributed on particular industries such as financial services, insurance, IT and digital, to the extractives and shipping, to other businesses, to the advisor community, also to business association, importantly also academia and civil society. One of the things we're not showing here, but of course we also looked at, I think we have a very good regional representation, so they're coming from all corners of the world. So we think, as this is a global exercise, thank you very much for everyone that has sent in submissions. Also, thanks to BIAC here, I see Will, for, facilitating the process. I think it's been a tremendously successful process in terms of just getting the input in, recognizing that there are a whole host of other priorities. There was Christmas and other things, but you did not shy away from, offering your thoughts, ideas, and importantly, and I'll get to that specifically also, not just in identifying problems, but very often also coming with ideas of changes, of solutions, sometimes even of drafting. So that is very much appreciated as a word to all of you, whether it's from the civil society, from business, and any other stakeholders. Very thoughtful, broad, and insightful comments across a cross-section of those affected and those having a stake in the process and the policy outcomes. So that's perhaps a brief word on the first slide. We then go to the second slide. It's a bit of a recap, and I'm not going to walk you through all of this, but this is just sort of recapping what the pillar looks like if you break it down into components, a bit like what we did in Pillar 1. What are some of the building blocks? You see on the left the so-called GLOBE rules. And the first part, of course, they are the same for the income inclusion rule and the under-tax payment rule that then either allocate or attribute. We will be having a panel, I think specifically on this block on the left here, where you see sort of chapters 2 to 7 on the base and simplifications. So that's one of the things that we will focus on in panel 1. And then in some sense, the other chapters, including the top-down approach, split ownership, the under-tax payment rule, the subject-to-tax rule, rule coordination in chapter 10, is really part of panel 2, where we're going to go through. Just a brief word here on the special rules, on which we will not be, giving you much of a summary here. There's no separate slide. That's not because they're not important, but we didn't get that many contribution on these special rules in chapter 8. So a relatively low number, understandably also, because in some sense there's the income inclusion rule, the undertax payment rule, the subject to tax rule, and then it's an additional rule, it's a special rule. Suffice it to say that I think of those comments that we have received on those special rules, I think the majority, and we're talking single digit here, is that maybe that's a bridge too far. There's questions whether it adds unnecessary complexity, and if it does do that, whether perhaps they should be phased in their implementation, so the focus could be on the other rules. And perhaps there's sort of a step two, and that people are also worried a bit about the additional level of complexity that would be introduced by the introduction of these special rules that are discussed in Chapter 8, but a small number of comments. So that's all we wanted to say about that. So then I will start to take you through, together with John and Lee, sort of giving you a bit of the flavor on the key building blocks and what sort of comments we see, again, with sweeping generalizations, given the insightful and diverse nature of the various comments and their quantities that we have received. So that then takes me to the next slide, which is the question on scope. Broadly, I think, and perhaps unsurprisingly, but positively, I think there's broad support for the overall approach set out in the blueprint. That is not suggesting that people broadly support a minimum tax, and people have various ideas on the policy as such, but if the question is, well, if you were to do a minimum tax, let me look at this technically, is this a sensible approach overall? Then by and large, I think we see this confirmed. And we're going to talk about it in the panel more. I think when we then look at the specific comments, and that seems to be the focus, I think we see specific comments. I mean, we have a variety of specific comments, but if we try to cluster them and see, is there a proliferation of comments in particular clusters, then the answer is yes. I think one is around the excluded entities, and in particular interventions and comments by the investment funds or on behalf of investment funds and pension funds, that in principle welcome what the blueprint does, that it does recognize that if there is collective investment vehicles and there is a consistent policy around the world to not add an additional layer of taxation on these pooling vehicles, recognizing that is done very, very differently, but that there is a theme here that that is not something that is intended to be undermined, if you wish, by the application of Pillar 2, which is why it creates an exemption, which in many cases, because often it's not consolidated, is already built into the design of the rules, but not always, and because that's not always the case, we have special rules in Pillar 2. And then there are specific questions about how perhaps revisions could be brought for particular circumstances. Seed funds have been mentioned by the insurance industry, other features where there's a suggestion that perhaps we could make a more effective use of the concept of transparency to address some of these. There's also comments where the fund is not at the top, but further down in the chain, and how this situation could be addressed. So thank you very much for these comments. We will, of course, take them away. We will be reflecting on them, and there may be some good ideas, and much appreciated also that in pointing out the difficulty, most of the commentators also pointed to solution, always the most welcome approach in comments. There were then also questions on revisions as to the definition of non-profit organization, and I think that cuts across also to the subject to tax rule. And then perhaps sort of the third point here to make is that also, as regards the possible carving out of shipping and the reasons for that, we got some further interventions I think that will be helpful in bringing forward the discussion of what exclusions there might be and the reasons, and the line drawing exercise, including also what a technical translation of a possible exclusion might mean, should there be such an exclusion. And the last point, in some sense, which you can put under scope or you can put under simplification, I think here we've put it under scope. There are a number of suggestions that somewhat similar to the suggestions that we've heard in Pillar 1, perhaps less pronounced, less frequent, but nevertheless existent, that did suggest that maybe also here a phasing might be a useful idea. So one gains experience with the calculation of the base, with some of the application of the rules, and one would start with a smaller set of companies, of those that commented on the point that the idea would be to start with a higher numeric threshold, and then taking it down, so a sort of a transition phase in based on revenue. That's certainly something that we have heard, which we picked up here in scope, but we could have easily otherwise addressed under simplifications. I think that's the scope question, and if I'm not mistaken, I think John has unmuted himself because I think he's taking it over from here, and I'll get it back in a moment.
So thank you very much, Arkham. So building then on the question of scope, the next chapters in the report cover the question of how you determine the ETR for the globe rules on a jurisdictional basis. This is an overview here, so I'm not going to take you through this in extraordinary detail, but there are a number of steps that the blueprint sets out for determining the ETR, and each of those steps plays an important functional role in trying to arrive at a sort of a robust but yet accurate determination of the tax paid on economic income in each jurisdiction. And if you take, for example, the first two steps in the slide, where you start with the financial information that is used by the constituent entity in the preparation of its consolidated financial statements, and then there are a number of adjustments that are made in order to sort of align that with the policy of the globe outcomes in determining the tax base. The feedback that we got on those general steps is that there's strong support for the use of financial accounts as the starting point. General, if not, almost universal support for that, certainly as a simplification measure, but also as a way of achieving, transparent and standardized outcomes across these rules. And then we did solicit some particular comments in relation to particular items of the permanent adjustments, portfolio dividends, in relation to reorganizations as well. But we also got some other comments, particularly in regards to the treatment of exempt government debt and the treatment of government grants and tax credits. So we did get some quite specific detail on those points, which we will sort of take away and look at in the context of our working party discussions. The next two steps taken together is the identification of the covered taxes, and then the allocation of those taxes to the jurisdiction where the income is treated as arising in respect of the constituent entity. Again, this is material that we've covered for previously in other consultations. So there was support for the definition of covered taxes. Some discussions around some of the methodologies that were discussed in the blueprint for doing this allocation of taxes to a specific jurisdiction, and some technical issues that were raised there by submitters. But in general, support for that type of approach if you're doing jurisdictional blending on a jurisdictional basis. Some comments, however, sort of identifying the complexity associated with those steps and suggesting that a simplification could be developed that used a global blending model. Then finally, there are sort of adjustments that you then make to your overall tax calculation based on a substance carve-out, where you have substance in a jurisdiction, and also mechanisms to address, to achieve a smoothing mechanism that will be designed to address timing differences. I think that the general reaction from business was that they supported a substance-based carve-out, but sought to broaden out its scope in certain areas and certain contexts, and did not want us to adjust for covered taxes in relation to the portion of the income that was carved out under the substance carve-out. A number of other submitters, particularly in the NGOs, pointed to the fact that the carve-out was, in one sense, a weakening of the rules, because it provided a certain portion of the income that would be outside the scope of the rules, and raised concerns about what that was achieving from a policy and outcomes perspective. In terms of timing differences, there was strong support amongst the business community for us taking a serious look at the use of deferred tax accounting as a mechanism to address timing differences, rather than the carry forward mechanism that's articulated in the blueprint, with specific comments from particular industry sectors that saw themselves as being having particularly adversely affected and at risk under a carry forward style model. If we can turn to the next slide. So there was a chapter on simplification options, chapter 5 of the blueprint, and it was a core focus of this public consultation. We got more than 150 pages specifically on the simplification measures, and there are a number of other discussions and other parts of the document also referred to possibilities on the need for simplification. Businesses, raised concerns around the complexity and the administrative burden associated with all the Pillar 2 calculations. It's really a response, really, I guess, to the complexity that is inherent in certain aspects of these rules, and the needs to obtain additional data points in order to do these calculations. And a concern also arose here that simplification wouldn't be effective unless it came with the concomitant tax certainty, that a particular simplification option only worked if that worked for all jurisdictions in the application of these rules. At the same time, other submissions in relation to simplification expressed the concern and emphasized that these simplification options shouldn't be effectively a back door to undermining some of the policy objectives of the globe. If you oversimplify the rules and you create easy outs in relation to some of these outcomes, then you can undermine the original stated policy objective of the globe. If we could turn to the next slide. This slide sets out, and perhaps somewhat graphically, the levels of support as we read them in the submissions for the various simplification options identified in the blueprint. The strongest support was for the tax administration guidance, particularly from business, and the reason for that, as articulated, was that it would be a stable type of simplification and didn't rely on there being any particular calculations that needed to be made to qualify for it. So it was certainly easier for businesses to apply, although there was an acknowledgement, I think, in that case that there needs to be nevertheless a transparent and non-political process associated with development of that guidance. Equal levels of support, and still quite strong, were given to developing a safe harbour based on CBCR filings, where the key value driver for that would really depend on the adjustments that would be required to the CBCR data that was being currently prepared. Obviously, the closer we can make that simplification to the existing CBCR data, the fewer adjustments that need to be made, the simpler the methodology would be. Some submissions did, however, raise the concern around taking CBCR out of a framework where it's used for high-level risk assessment and bringing it into an assessment regime like the globe, and what the implications would be for CBCR in that context. So some thinking to do about the division between CBCR as an information exchange mechanism on high-risk assessment and the types of data sets that are concomitant with the Pillar 2 design. In terms of the de minimis profit threshold, also, the support for this is contingent on there not being too many data points that need to be collected, and also a preference amongst a business certainly for a high threshold for a profit calculation, based on a relative percentage of the M&E's profit rather than an absolute number. And relatively less support for the option of doing a single ETR calculation that could span a number of periods. The next slide touches briefly on the comments that were made in relation to the allocation mechanics under the rule, the income inclusion rule, and the undertax payment rule. Generally, there was strong support for the top-down approach that's set out in the income inclusion rule, where the rule is applied at the top of the ownership chain. And those submitters that touched on the subject of split ownership rules identified some of the potential complexity that could arise there, and gave different views on the threshold that should be applied in relation to the split ownership rules. In terms of the undertax payment rule, equally, concerns about the complexity there, combined with the need for the required coordination that would be required, because this would be a rule that would apply to a common tax base, but be simultaneously applied under a common allocation key in a number of different jurisdictions. So with the additional concern around coordination, and particular concerns about the way the rule would apply to the low tax profits in the parent jurisdiction, sometimes thinking about the interaction between those rules and the carry forward mechanics. So some good, detailed, thoughtful submissions in that space, and we're very grateful for that input. And recognizing the complexity of the rule, there was support for additional simplifications in the administration of the rule. At that point, I'm going to ask Lee Harley, who is leading the work on the treaty side in relation to the subject to tax rule, just to take you briefly through a high-level overview of the feedback we got on the subject to tax rule.
Thank you, John. So the main theme among the general comments that we received on the subject to tax rule, which you'll remember would result in gross basis taxation, was that it gave rise to a pronounced risk of over-taxation. Commentators thought generally that gross basis taxation was something that sat a bit oddly within the general scheme of the GLOBE proposal. And whilst there was an acknowledgement that having a lower trigger rate for the subject to tax rule would go some way towards ameliorating these concerns, most commentators thought that that was quite a blunt tool, and that rarely would a low rate on the gross income approximate to the agreed minimum rate on the net measure of income. Although commentators did say that if the subject to tax rule were implemented, it would be essential to set the trigger rate for the subject to tax rule below the general GLOBE rate. There were also widespread calls for a narrower scope of subject to tax rule, both in terms of the categories of covered income, with most of those who commented favouring limiting the rule to payments of interest and royalties, and in terms of the choice of a materiality threshold, where again, the majority view was in favour of having an M&E size threshold aligned with the broader GLOBE proposal, or even starting somewhere a bit higher, so the 750 million euro threshold for materiality. Questions were raised about the priority subject to tax rule. Most business commentators thought that the income inclusion rule and undertax payment rule should come first. But there was also concern expressed by the NGOs that source country concerns were at risk of being sidelined in the process. Whilst they acknowledged that the subject to tax rule was intended to address those concerns, the NGOs didn't think it went far enough. And because it requires treaty change, there was a concern that that would be difficult to secure in practice. There was even a suggestion that if their concerns were not really taken on board, those source countries or lower capacity countries may even be better off terminating their tax treaties. On the administrative approaches, most of the commentators supported the ex post annualized charge approach to dealing with these things. That would mean there would be no need to have withholding taxes, contingent withholding taxes on the categories of covered income. And most of you who commented on that also agreed that under that approach, the charge should be applied to the payee, to the entity that receives the income. So there was support for that proposal. That's a very kind of broad overview of the comments that we received on the subject to tax rule, and I think it may be back to Akim.
Thank you, Lee. Yes, I'll finish off, I think, with the rest couple of slides that we have. I think that's the chapter you remember when you look at the picture on the right, questions on implementation and rule coordination, a key topic, because certainly there's no suggestion that you would want to go from below a minimum tax to double tax, and so you cannot apply these rules at the same time, requiring both a consistent implementation and a rule ordering that would be necessary. So in terms of the comments, I think, again, trying to give you a flavor, I think there's a strong support for the coordinated approach suggested for IIR UTP, including on the rule order, noting, however, I think as John's already mentioned, that NGOs would prefer a different rule order for the reasons I think that we have discussed at the last public consultation already. But otherwise, I think we have strong support for the rule order. And again, the panel will be looking into these questions to expand a bit on the relevant discussion where we're at. I think there is unequivocal strong support for the notion that model legislation and guidance would be provided as a key, maybe not sufficient, but certainly necessary element to create consistency so that we're operating off the same rule book, especially given that rule coordinate is essential the way, for instance, the under-tax payment rule interacts with the income inclusion rule to avoid duplicative application. I think there's also a significant contingent of commentators that argue for a deferred implementation of the under-tax payment rule. So not a suggestion that there shouldn't be an under-tax payment rule and that the under-tax payment rule and the income inclusion rule could be agreed at the same time, but that there should be a space created for the legislation and implementation of the income inclusion rule, just so that we don't end up with an untimely, so to speak, early and unintended application of the under-tax payment rule because the process on the implementation of the income inclusion rule isn't yet complete. That's certainly something that we have heard in the comments. Then under the next one, support for a multilateral convention. I think that's also a theme that comes through in the comments. Why is that? One, of course, to ensure the consistency and coordination in the application of the income inclusion rule and the under-tax payment rule, that everybody does them in accordance with what was agreed, and that their application and is then also coordinated internationally. Second, I think there is a concern that this, or there's not a concern, there's, I guess, a suggestion that this would be the best place where, if there is risks of double taxation that may nevertheless arise, that then that would be the best place to have mechanisms to prevent such disputes from arising, or where they do arise, to have instruments that deal with their resolution. And again, that could be something that's in the Multilateral Convention. Some commentators also referring to Pillar 1, suggesting if there was a multilateral convention, then maybe there could be one. So we've heard that as well. And of course, you know, the exchange of information part could also be in here, recognizing that certainly on the exchange of information, of course, there are existing instruments, including multilateral instruments that already exist that permit the exchange of information very widely already. And then maybe last here, the point, interaction with other rules. And that's, I think, a point that has come out relatively strongly, one could say, and one can understand, to say, well, if we are now having a global minimum tax, for lack of a better word, would that be an opportunity to then also look at individual countries' other avoidance measures and question whether they might still be necessary? And then the question whether a simplification and understanding simplification more widely could not only take place within the Pillar 2, and we'll discuss that in the first panel, but then also whether, if you look at the system holistically, whether there may be certain things that have less of a policy justifications in the context of an existence of a Pillar 2 than they might have had in the absence of a Pillar 2. And so an ask, if you wish, from many of the commentators for tax policy people to reflect on the system on the assumption that there is a global minimum tax, a Pillar 2, and what that might mean as to whether a number of the current rules that go to particular aspects now covered would still be necessary, or in the interest of, you know, the burdens and benefits could then be altered, revised, removed, whatever the case might be. And then maybe, I think, moving to the last slide, the question of guilty coexistence. It's the least important, which is why we have last, also not the most important, but certainly an important point that is coming through the consultation. Guilty coexistence. We're trying to summarize these comments in these sort of three headings, and that roughly we think does justice by classifying them, but by no means are we suggesting that we have here a summary that goes into the level of detail that we have in the comments. And I think it is also a topic that we will be looking at in the second panel in more detail. But trying to give you an overview, I think there is strong support, as we say here, for treating guilty as a qualified income inclusion rule. And importantly, you might say this is comments that are coming from businesses from around the world and not specific to one particular country. So that seems to be coming through quite strongly. There is still, I think we also need to say, among some of the submitters, a concern expressed about the global blending approach within current GILTI and how that compares to the globe approach. There is a recognition that one does need to look at this holistically and that there's other features, carve-outs, carry-forwards, and other elements that are in globe and that are not in GILTI, but nevertheless, there is that point being made. The second group, I think, is, so to speak, the sandwich structure, where it is a US intermediate holding company subject to GILTI, and that there's a good income inclusion rule on the top. And there's two sets of comments, if you wish. One suggesting that you would deactivate GILTI following rule letter in those circumstances, or where this is not possible or was not happening, then there would need to be some further guidance on potentially how the allocation would work, as it would require a translation of a global blending system into a jurisdictional blending system, something that is not easily done without any guidance, and the suggestion that if that was the decision, then that guidance would need to be developed to make that approach feasible, if that's what desired from a policy perspective. And then the last category here that we have is the coordination with other rules type, where there is a number of suggestions that make the point that if there is a grandfather of GILTI as a good income inclusion rule, then there is a certain policy logic to suggest that that means one generally turns off the undertax payment rule. And if you flip this in the US context, there is a suggestion by a number of commentators that that would then also suggest to deactivate the BEAT, where it would otherwise be applied to a group that's subject to a good income inclusion rule. And the last point on the rule coordination that's also being made is that there are some suggestions that where there is a good income inclusion rule and or a deemed good income inclusion rule GILTI, not only should this turn off the application of the undertax payment rule, but it should also turn off the application of the subject to tax rule, something I think that John and Lee have already touched upon. So Mr. Chair, Marco, I think that's, the end of our summary, trying to go high level through at least sort of the themes that we think are coming out from the public consultation. We will be taking all of these comments away to the working party that you chair. So there will, of course, be detailed technical discussions on all of them. But that's, I think, concludes our at least high-level summary of what we are seeing, main themes in the comments that have come in. And thank you again to all of those that took the time and effort to submit them. Back to you, Marco.
Thank you very much, Akim, and thanks also to John and Lee for this short but comprehensive overview of the input from received in the public consultation from stakeholders, and I think that this, has summed up in a very clear way the major issues that are of interest or concern by the stakeholders. So thanks again for this. I would suggest now we move to the first panel. The first panel, a number of panelists has been invited, and I thank them for their participation. There will be also some discussant, and also thanks Akim for moderating this panel. And so again, back to you, Akim, for presenting the panel and moderate it.
Thank you, Marco. Yes, we'll now start with the first panel. I'll give a quick introduction, much like we did it yesterday, but I will do very little of the actual talking here. Let me first introduce you to the panel and also the discussants. And for those that turned in yesterday, you've already seen we're following the same process. So we're happy to have an outstanding panel, I think. We have starting with Professor Dr. Joachim English, who is director of the Institute of Tax Law at Münster University, and somebody who has thought deeply and published widely, in particular, but not only, on Pillar 2. So he's been with us for a while, and we're very grateful for his contributions, and we'll call upon him. He'll start in a minute. Then we have Anne-Marie Wolf, who is the head of tax of Rio Tinto. Thanks very much for being with us, and she will speak second. I'll talk a little about what our idea was on the topics and why we specifically felt that they should make a contribution here in our public consultation in a minute, but I'll give you the overview of who's on the panel. The next person on the panel is Jesse Eggert, who is a principal with KPMG. Then we have Catherine Harlow, who's the head of transfer pricing at AstraZeneca. And then we have Xavier Durand, who is the head of tax and customs at Michelin, and Tania Solier, who represents MEDEF, the French Business Association. After that panel discussion, we'll also have observations from our discussants, and those are Jane Gill, who's the head of tax at GlaxoSmithKline, from David Murray, who's a tax policy principal at Anglo-American and a member of the Tax Executives Council. And it's that letter submission that we thought was quite insightful on some questions, so we'd ask him, and he kindly agreed to speak to those. And last not least, we have Paul Arnoff, who's the Vice President and Tax Counsel of Prudential Financial Insurance, and is also part of the insurance company working group on BEPS. So that's our panel. I would just say a brief word before handing it over to Joachim, which is of course easy. If an Achim hands over to a Joachim, it's an easy transition. But that's not the reason, of course, why he goes first. Just a quick recap. This first panel is on tax space and simplification option. And as most of you would probably agree, these topics do need to go together. I think one of the messages I think that has come through clearly from certainly a number of business commentators that ideally the tax space would be so simple that there would be no need for simplification measures. And if there are simplification measures, we need to make sure that the rule design is such that they don't get separated out so that we have one rule, but then very different simplification measures by very different countries, which in the end then could still create inconsistency, complexity, and unnecessary compliance costs. That's certainly a message that we've heard. If we step back just a second as an introduction, then that in some sense was the core topic of the public consultation that you remember that we had under also difficult circumstances in December, where we focused very much on the tax space and simplification as part of the tax space, but on the tax space. Much of what you now see in the blueprint, in fact, is derived from or derived in discussions on the basis of the input that business and other stakeholders, I remember Oxfam and others that we had on the panel at the time suggested on how this could be done. And so in some sense, this is the second public consultation. But of course, when we did this in December of 2019, we had only questions and you had to give the answers. And there was a legitimate concern that it was good to have this type of consultation, but it would be much better if there was an actual outline of the Pillar 2, which this time we provided. So now it's not just seeking input, it's commenting on what we have developed, we being the working party in particular that Marco is chairing, but of course also wider discussion in the inclusive framework in terms of what the tax base could look like, and now you have this, and so we're grateful for the now second round of very detailed comments. Let me also perhaps point out, perhaps the obvious, but maybe as a recap that is useful, that when we started this discussion, and those that participated in the public consultation in December of last year might recall this, there were earlier questions that a tax base maybe shouldn't be based on financial accounts, but the tax base could be the tax base of the shareholder jurisdiction, something we typically find in CFC rules. And I think part of the reason that we went to financial accounts was already, if you wish, an idea of simplification, because we recognize that in many countries, other than the US, very often the practical application of CFC rules did not require the recomputation of foreign earnings and profits in accordance with the shareholder jurisdiction. And many concerns by businesses that such an approach would trigger higher level of compliance costs. There was also the point being made that it would result in an unlevel playing field because different base would have different results. And if we wanted to ensure that M&Es operating in different countries were subject to similar rules, that might not work if there is no common base that helps us together with the rate to create that level playing field. And then third, I think it was a recognition that that approach would not work for the undertax payment rule because businesses may have to recompute earnings and profits 100 times the dependence with the number of payments subject to this, of the base. So all of that, in some sense, drove us to financial statements as the principal base. And I think, as John has said, I think there is a very large degree of support that that's the right approach if you are doing, I need to add, a minimum tax. That's the basis to use, consolidated financial statements at the parent level. I think there's a lot of support on those elements of the base. A second point, I think, to observe here in our discussions, we have a number of permanent adjustments. I think those are also the ones that came most frequently from business interventions that have commented. And of course, there's always a tension. There's a tension that we hear little adjustments as possible, but at the same time, strong observations from those affected that, but here we need an adjustment. So it's a challenge for the group that Marco chairs to navigate these two conflicting concerns about limiting the number of adjustments, some suggesting no adjustments. At the same time, very often we then find a specific request, but here I need to make an adjustment. And that is, I think, just a challenge that we need to make. A third observation, just very briefly here, the CBC point that's being made in the comments, I think the idea on CBC, and the panel will talk about this, is that can we build off the processes perhaps that companies have already in place rather than necessarily the CBC filing itself? So the driving point is the reflection, if we rely on a system of collection of a process that already exists and generates data points, then maybe can we use some of those data points, which may or may not be inside the formal CBC or not, because the underlying is the more important part, the part about reducing the need to create new systems and generate new data points, whether inside or outside the CBC. And then last, and I think that's the overriding point, and with that, I think I give it to Joachim, is that there is a recognition in the working party that the simplification and the base together should avoid a result where you need to make a jurisdictional computation despite the fact that both the tax administration and the taxpayers essentially already knows that there will be no inclusion. So how do we find processes and approaches, and this is the core of the simplification discussion, that avoids taxpayers making unnecessary calculation where there is a very high probability that the outcome will result in a non-inclusion. So we save tax administrations from having to look into those places, and we save taxpayers from having to make calculation, but there's really no need to make that calculation because we are pretty sure on the outset that there is very unlikely to be an inclusion in those particular jurisdictions where the M&E operates. I mean, these are maybe just some introductory comments and a bit of background to set the stage, but with no further ado, I shall now rest my case. I hand it over to Joachim, who will, I think, speak both on the overall design of the tax space and picking up in particular on the points he raised in the submission, talking about the carry forward approach, carve-outs, as well as simplification option. Joachim, the floor is yours.
Well, thank you, Chair. Thank you, Joachim. Well, dear participants and audience, I guess the real reason why I go first is to subtly let you know that you have maybe arrived at a duller part of the blueprint discussions because a German academic has been chosen for the introductory statement. Well, nevertheless, I'm of course grateful to have been given the opportunity to speak, and maybe the more technical character of the discussion, which I'm about to enter into, is also merely a reflection of the fact that the minimum tax proposal has reached some greater maturity as compared to Pillar 1. As has been said, this panel will focus on the design and technical aspects of the global tax base determination and ETR calculation. Now, as to general design questions, I think I need not add much to what has already been said by Joachim and others. I think we should recall that there's three fundamental decisions that the inclusive framework has taken, which build to a certain extent the framework of this panel discussion. The first one is to go for jurisdictional blending instead of a global blending. The second one, which is then also related to a certain degree because it provides a certain degree of simplification, is to choose the financial accounts of M&Es as a starting point for calculating the base. And finally, the third one is to use a common tax base for both the income inclusion rule and the undertaxed payment rule. And the choice of the jurisdictional blending in particular, in combination with those two other decisions, increases the administrative complexity and compliance burden of the GLOBE rules. I think that is generally acknowledged. It has, however, been politically accepted because global blending has been considered, and in my view, correctly so, to dilute the effectiveness of the minimum tax. But nonetheless, this choice then results in an increased need for simplification measures and an adjustment of timing differences. So I guess this is a little bit the background and the framework of our entire panel discussion here. Obviously, it would be a bit of a challenge to address all the relevant aspects in this session, let alone in my intervention. So I've been asked to instead focus on a few particular points that I've also raised in my submission concerning the design of carry forwards, of the carve out, and of one of the simplification options. And furthermore, I'll take the liberty to share a few thoughts on dispute prevention and resolution. So starting with carry forwards, they are conceived as a core instrument to address tax-based volatility due to timing differences. And to this effect, as has already been explained, losses and excess taxes from prior periods can be carried forward for GLOBE purposes. Now, the loss carry forward in particular will be granted independent of local carry forward rules. This divergence between the GLOBE or loss tax carry forward and the local, if existing, carry forward can, however, create some complexities, and it can become problematic in particular in an M&A context, as a consequence of which an entity with a loss carry forward might enter the M&A group and become a constituent entity. Now, in my view, in principle, this loss carry forward from a new constituent entity should then also be taken into account for the purposes of the GLOBE-specific loss carry forward rules. However, the corresponding deferred tax asset might not be reflected in the financial accounting of the target company that enters the group, and in a correspondingly higher acquisition cost for that company, especially for where the local carry forward rules do not permit a loss carry forward post M&E, or where they are less generous than the GLOBE rules. And I think that in this case, tax planning opportunities arise, and the acquisition of lost shell companies could undermine the efficiency of GLOBE. And this is, as far as I can see, not as yet reflected in the blueprint, and I consider it necessary to limit the GLOBE loss carry forward in such scenarios. My second point are carve-outs. For the sake of political compromise, a formulaic carve-out for substance-based profits has been included in the blueprint after lengthy deliberations from what I could see. Qualifying profits are calculated according to the blueprint now as a fixed return on the combined amount of local payroll expenses and depreciation of certain tangible assets. And no top-up minimum tax will then be applied on such deemed routine profits, even if their ETR is below the minimum rate. The rationale underlying this carve-out approach is really that this deemed return is presumed not to be susceptible to BEPS because it just represents a routine return, usually not involving any intangibles, since intangibles are not featuring in the calculation of this routine return. And so there is only a need regarding the remaining excess profits generated in the respective jurisdictions, so the residual profit generated there, and the remaining covered taxes that need to be taken into account for the purposes of calculating the jurisdictional ETR and an eventual top-up tax. So what is controversial here? Well, the problem is that to me, it would seem logic that then covered taxes levied on the carved-out profits should be excluded from the calculation of the effective tax rate on any remaining excess profits. However, the blueprint mentions that some member countries of the inclusive framework would prefer to take those covered taxes too into account for the ETR calculation of the residual profit. And what I've just heard from John, seemingly the same is true for most businesses and their preferences. This might be so because it would serve as a mechanism to leverage the carve-out beyond its direct effects by counterfactually imputing all covered taxes related to a jurisdiction only to its excess profits, so to its residual profits, and thereby artificially inflating the effective tax rate of those residual profits. Now, de facto, such an approach would partially shield also excess profits from minimum taxation in jurisdictions with substantive activities. And in my view, this should not be the case, both on grounds of transparency, but also in order to preserve the rationale underlying the carve-out approach. So if you want to shield more of the profits with underlying substantive activities, I mean, the way to go forward would be to raise the percentage that is applied to the payroll and to the depreciation rather than choosing this relatively intransparent approach. On we go to the simplification options. The blueprint contemplates both certain safe harbor ETR thresholds and a de minimis profit exclusion for jurisdictions where only a relatively small share of the overall M&E profits is located. Now, for reasons of time, I will only address a particular aspect of this de minimis mechanism. The underlying idea here is that IP holding vehicles are responsible for most of the still remaining BEPS issues which GloBE is supposed to address. However, BEPS Actions 8 to 10 and its DEMPI rules now prevent M&Es from allocating intangibles to a multitude of IP vehicles in different jurisdictions. And as a consequence, BEPS-related profits of an M&E, to the extent that they still exist, should be concentrated in at most a few dozen jurisdictions where the IP can still be allocated to. And the other ones with small profit shares should then not need to be subjected to minimum tax scrutiny. So far, so good. But according to the blueprint, it is still undecided whether the de minimis profit share would be calculated as a percentage of global pre-tax profit, so including the ultimate parent jurisdiction, or only as a share of foreign pre-tax profits, so excluding the ultimate parent jurisdiction. And here I think we should consider that the simplification measure, as I said, will take uniform effect as the entire tax base calculation for the purposes of both the income inclusion rule and the undertax payment rule. And the latter, so the undertax payment rule, also applies with respect to any eventual low tax profits of constituent entities resident in the ultimate parent jurisdiction. So in my view, it would therefore be consistent to calculate the de minimis threshold based on global profits, including the ultimate parent jurisdiction. And this is, I think, also in line with its underlying logic of this simplification measure, since intangibles can, of course, also be shifted into the ultimate parent jurisdiction. Well, finally, a few words on dispute prevention and resolution. I think it's rather obvious if you look at Pillar 1 on the one hand and Pillar 2 on the other hand, that compared to Pillar 2, the blueprint on Pillar to Pillar 1, the blueprint on Pillar 2 is relatively vague on new instruments for dispute prevention and resolution, or on how the existing instruments could be enhanced for that purpose. Nevertheless, it should be acknowledged, and I think it has also been acknowledged in the introductory remarks given by the chair, that despite the already relatively detailed OECD guidance, and I'm sure more detail might be added, there is a risk of double taxation, especially where the undertax payment rule comes into place, or where there is a need to coordinate guilty coexistence with other minimum tax approaches. And existing approaches that we already have in place might not be best suited to deal with the issue, because similar to Amount A under Pillar 1, it would usually require multilateral instead of bilateral coordination. So one dispute prevention measure that I could think of that should be explored in my view is to expand the required country-by-country reporting information and to include also the relevant payment streams that are needed for the application of the undertax payment rule, so that all the jurisdictions at least have this calculation factor as a uniform one. And moreover, the ICAP and joint audit initiatives of the OECD should be relied on also for GloBE issues. Finally, regarding dispute resolution, I would consider it useful to extend the beyond Amount A mechanisms that are contemplated under Pillar 1 also to Pillar 2 related disputes. So after this somewhat arbitrary selection of a few specific issues, perhaps a general remark to end on. In my view, it should not be necessary to streamline the GLOBE rules down to every detail. If guilty coexistence with GLOBE rules is accepted as it is, affecting roughly 1/3 of the potential overall GLOBE revenues, certain leeway should then also be ceded to other countries that commit to GLOBE. And here the IFRS equivalence test that we find for national accounting standards provides a good model in this regard. And I think this approach could also be considered for other elements of GLOBE as well. Thank you very much.
Thank you, Joachim. Thanks for coming in. Thanks for setting the stage as effectively as you've done. And thanks for your insight on a number of important issues where you've touched upon, and we'll certainly take that away and highlighting what is in your submission. We may come back later. There may be questions from other panelists, but for now, we turn over to our next panelist, which is Anne-Marie Wolf, as I said, the head of tax from Rio Tinto. And I think she will mainly, but maybe not exclusively, but certainly mainly focus on the use of deferred tax accounting versus the carry forward credit model that is in the current blueprint. Anne-Marie, the floor is yours.
Thank you, Achim. Please let me know if my bandwidth starts to struggle, and I'll turn my video off if that happens.
All good.
But thank you for the opportunity to participate in the panel. And I just want to acknowledge the significant amount of work that has gone into the blueprints. Very impressive what's been achieved in the amount of time. What I want to do first is to just give some background on why timing differences are so important. And my starting comment is that I like to think that there is no disagreement that where the local statutory corporate tax rate adjusted for permanent differences is above the GLOBE minimum rate, that there shouldn't be top up. So that's my kind of starting proposition. However, if you are looking at an effective tax rate that compares cash tax paid to accounting profit, that's not going to achieve that outcome because of timing differences. And that's because corporates don't pay tax on profit, they pay tax on taxable income under the local tax laws. And so local tax laws require adjustments to accounting profit to reach the taxable income on which cash tax is paid. And many of those adjustments are actually timing differences. And those timing differences, of course, by nature, reverse in a later year. So comparing cash tax paid to accounting profit as a means of trying to measure the level of taxation applicable to that profit is basically a comparison of apples and oranges. But a core point, I guess, that needs to be understood is a timing difference, because they do reverse, they don't result in undertaxed profits. They're simply the difference between when something flows through the tax calculation compared to when it flows through the accounting calculation. And deferred tax accounting is the mechanism that keeps track of those differences. For many industries, in particular capital-intensive industries, the size of timing differences can be very significant, and the period over which they can reverse can be extensive. In some industries, that can be decades. If you pick up the accounts of any extractives company, you'll see the sheer size of the deferred tax balances on the balance sheet, and these arise as a consequence of the large amounts of upfront investment that are made in capital-intensive industries. As timing differences reverse over time, the actual effective tax rate will equal the local statutory tax rate, ignoring permanent differences. So to give you a very simple example, a capital-intensive project with a life of 20 years in a location with a 25% tax rate, that project may have an effective tax rate under GLOBE of 0% in the early years as a consequence of timing differences. Over time, as those timing differences reverse, there'll be some years where the effective tax rate under GLOBE will be significantly greater than the statutory rate of 25%. But over the entire life of the project, the 20-year life of the project, those profits will have been subject to the local statutory corporate rate of 25%. So as you can see, if you just look at the effective tax rate on an annual basis without acknowledging timing differences, it's going to lead to conclusions of either undertaxation or even overtaxation compared to the globe minimum rate, when in fact that's not the case. The blueprint appears to express an intention that timing differences should not give rise to a permanent tax liability. However, the proposals in the blueprint as they're currently drafted won't achieve that outcome. And what I found really interesting is the rejection in the blueprint of deferred tax accounting as a means to address timing differences, and that's quite difficult to understand for a number of reasons. Firstly, deferred tax accounting is something that is embedded, or it's dictated by the same international accounting standards which are underpinning the globe rules themselves. So the determination of the denominator, profit, is determined based on international accounting standards. Deferred tax accounting is well understood, it's standard practice, it forms part of existing compliance processes, it's independently audited, it's transparent. You can pick up the statutory accounts and you can see the deferred tax flowing through. And contrary to the comments made in the blueprint, the application of deferred tax accounting is mechanical, is overwhelmingly mechanical, and involves very little judgment or estimation. And the limited areas where there is some level of judgment can be isolated, so we can deal with those. Contrast that to the fact that the level of judgment involved in determining the accounting profit significantly exceeds any judgment that's relevant in deferred tax accounting. And so it's curious to me that accounting judgment is accepted in the determination of the denominator for globe, but not the numerator. Pragmatically, a comprehensive approach to timing differences is not going to be possible unless deferred tax accounting is used. Trying to replicate it with something else is going to be horribly complex and prone to anomalies and inappropriate outcomes. And it's going to create winners and losers depending on the point and the reversal profile of their timing differences. Contrast that to deferred tax accounting, which could deliver an outcome where there is no double taxation or undertaxed profits, but without the need for complex transition rules, and it would take a significant amount of pressure off the credit and carry forward rules. If it's agreed that timing differences should not result in double taxation or over taxation, or under taxation for that matter, but deferred tax accounting is not adopted, there's a number of things that will be necessary in order to give effect to the policy objective. So firstly, the transition rules will be required to recognise pre-regime losses and timing differences. And the look-back period for that will need to be sufficiently long to recognise industries that have long-lived assets. The carry forward and credit rules will then need to do the heavy lifting to ensure that timing differences don't give rise to double taxation. And so absent unlimited carry forward rules, plus a carry forward mechanism, plus a carry back mechanism, plus the ability to get a refund, there will be effective double taxation. So timely monetisation of top-up taxes that are paid as a consequence of timing differences will be necessary to mitigate the NPV impact on investment. It would seem a bizarre outcome if businesses who routinely benefit from low tax rates can make full use of the carry forward and credit mechanisms to their benefit, but companies who are highly taxed won't be able to equalise their position. There's no value in a credit and carrying it forward if you don't actually have any undertaxed profits to use it against. The proposals in the blueprint don't achieve those outcomes at present and will result in double taxation. But as I said, timing differences go both ways. And so there is actually also a risk that timing differences may shelter truly undertaxed profits. And so I have no philosophical objection to top-up tax on truly undertaxed profits. The double taxation that I'm concerned about is the double taxation that will be experienced by highly taxed businesses with effective tax rates well above the minimum rate of tax. And for some industries, the impact of this is going to be sufficiently material to influence investment decisions. And countries seeking to attract investment in capital-intensive industries, for example, resource-rich countries, may be disproportionately impacted by that. The potential for timing differences to result in double taxation is acknowledged in the blueprint, and alternatives are proposed to address a limited category of timing differences related to fixed assets. And so a couple of comments I have on that. Whilst timing differences related to capital assets like depreciation are in many cases the most material timing differences, there are many other material timing differences that must be dealt with. Adjustments would be required to all of the proposals in the blueprint in order for those proposals to actually deliver what they're trying to deliver. Where there's only a limited category of timing differences that are addressed via specific adjustments, they will need to be supported, as I said, by the transition, carry forward and credit rules, and those rules would actually need to have modifications made to them in order to achieve the outcome that they're seeking to achieve. And the level of compliance that's implicit in those proposals can't be underestimated. So if I haven't managed to convince you that deferred tax accounting is the way to go, there are some practical points that I think are important in framing an alternative regime. Whatever approach taken, you can't look at timing differences at a single point in time. For example, transition. You have to think about the reversal. By definition, a timing difference at a point in time will reverse at a later point in time. And to complicate matters, on transition, these timing differences may actually be embedded in either an accounting loss or in a tax loss. And so there's three pieces of the puzzle that you need to solve for. One is the timing differences at the point of transition. The second one is the balance of any accounting or tax losses at the time of transition. And the third one are the base rules for timing differences in the globe regime itself. And so to the extent to which there's a different approach taken for each of those three pieces of the puzzle, there's going to need to be bridging rules to make those rules work together in a way that achieves appropriate outcome. But most importantly, in my view, you have to work out what the approach is to timing differences within the globe rules before you try to work out what the appropriate transition response should be. Even if we manage to get all of those things right, the additional complexity and compliance will be significant. And so the key messages I want to leave you with is the importance of getting timing differences right cannot be overstated, particularly for industries which have very significant timing differences. The proposals in the blueprint as they currently stand will result in double taxation. And as I said before, they may also inappropriately protect some truly undertaxed profit that should be subject to top-up tax. So changes will be required to achieve the appropriate outcome, even in respect of the limited category of timing differences specifically addressed, i.e. depreciation. The potential for double taxation will impact investment decisions. We've already been doing some modelling and the numbers are large enough in certain industries to impact investment decisions. And that may disproportionately impact resource-rich countries. The good... Can you hear me, Akim?
No, carry on. Sorry, I'm deliberately on mute.
Oh, sorry. Oh, okay, sorry. The good news is that a solution already exists in the foundation on which Pillar 2 has been built, i.e. the international accounting standards. And that solution is deferred tax accounting. And so if there's any concerns with deferred tax accounting, any specific concerns, we've done a lot of thinking about that, and we're confident that they can be isolated and dealt with. But let's not throw the baby out with the bathwater, is the key message there. And my final point is I welcome all of the discussion on simplification. As a person in a corporate who will need to deal with all of this, let me tell you, it almost makes me feel like it's time for retirement, but simplification is necessary. And the use of deferred tax accounting would represent a significant simplification within the rules. And so I will rest on that point. Thank you, Akim.
Thank you very much, Anne-Marie. And if anybody in the audience was not clear that that was a pitch for deferred tax accounting, let me underline that now. I think that you made that very effectively. And certainly the point about complexity, I think, is widely accepted. I think if we have a minute at the end of this panel, I can give the floor just very briefly to John, just to give you a sense of what are the reflections, why is the pillar, that's not to say the third tax or not, but to give like a full picture of the discussion, if time permits. But in the interest of time, let me go to, let me go to the next panelist so that we keep somewhat to the time. And I think the next panelist is Jesse Egger. Jesse, the floor is yours.
Yeah, thank you very much, and thanks more generally to the Inclusive Framework for the opportunity to speak today. I feel like I should also be thanking people for the opportunity to put on a jacket and tie, which I'm not sure I've done in about a year at this point. So I blew the dust off of this one, and we're good to go. Look, this is a challenging process, obviously, and I know you've gotten a lot of input from a lot of stakeholders with disparate views throughout the process. The blueprint represents a pretty tremendous job of trying to balance all of that feedback so far. And in particular, one focus that you mentioned, Achim, was the effort to find that balance between, the technically right answer and the most administrable answer. And that's sort of where I'll be focusing my remarks today. And in particular, I'll focus on some of the challenges presented by the effective tax rate calculations, the obstacles to simplifying that calculation directly, short of adopting deferred tax accounting, which I agree would represent a pretty tremendous improvement in complexity. And the need overall to minimize the number of taxpayers and jurisdictions for which that complicated effective tax rate calculation is actually required. And so I think this will serve as something of an introduction to the various simplification options that other people will on the panel will delve into in more detail as we move on. So, as has been said already, ETR can be distorted in any given year by the fact that we're using financial accounting principles to determine amount and timing of income, but we're using cash tax as our in order to determine the tax rate. How is that addressed? It's addressed either by, in some cases, deferring to tax rules or otherwise requiring some departure from financial accounting principles, or through a carryover mechanism intended to smooth things out over time with unclear effectiveness. The complexity in the Pillar 2 generally results from a mixture of those two things. So what that means is that addressing complexity is really challenging, because providing fewer exceptions to following financial accounting treatment up front means there are going to be more situations in which temporary differences between tax and accounting rules create tax liability. Providing for more exceptions decreases that problem, but increases the amount of work that has to be done to convert book results into a globe effective tax rate. And compounding all of this is the fact that while everyone truthfully says that they want to balance accuracy against administrability, different stakeholders have different views about which items are important enough to justify additional burden and which items can safely be simplified. So where can you sacrifice accuracy for administrability? And that's not to say there aren't places where that can happen and where agreement could be reached. I think there certainly are. Our comments have raised some of those, focusing on things like trying to simplify the treatment of dividends and gains, including portfolio dividends and gains, making sure that we are appropriately taking into account certain special items like appropriate treatment of regulatory capital that may otherwise result in inappropriately low ETR tax rates under the rules, making sure that CFC taxes and other similar taxes are taken into account appropriately, particularly in situations where a parent entity may be experiencing losses. These are all items that are appropriate to address and may be helpful in reaching a more accurate result or a more simple result. In some cases, both, relatively rare cases. But while those individual changes may be helpful, the internal structure, the dynamic between those carryover rules and the need to adhere closely to book principles in order to make the whole system administrable on the front end, all of that means it's hard to see an easy way to turn a calculation of jurisdiction by jurisdiction globe ETR into something that isn't pretty darn complicated and administratively challenging. All of that complexity is further exacerbated by the nature of Pillar 2. Taking a step back from the mechanics and looking at the fundamental design, Pillar 2 is designed so that taxes paid by multinationals in each jurisdiction are topped up to a minimum rate, either through the undertax payment rule or through the income inclusion rule. That design and the rule ordering creates pretty strong incentives for jurisdictions to adopt income inclusion rules in the first place. Once they do, the relevance of the undertax payment rule decreases in all but situations of direct payments to the parent of a group who has adopted an IAR, but due to timing reasons has low effective tax rate in their home jurisdiction. Outside of that circumstances, once we reach a cruising altitude where all or most relevant jurisdictions have adopted income inclusion rules and adjustments to investments by business have happened in response to the new rules, we'll have a situation where MNE groups are, with relatively high tax rates, are stuck performing complicated ETR calculations in every jurisdiction in which they operate. But as was highlighted again in your introductory remarks, those calculations will routinely result in no or very little top-up tax actually being owed, or will result in top-up tax only due to timing differences. And I think if we land in that place, taxpayers are going to start feeling like they're doing a whole lot of busy work for no real value, and tax administrations are going to be stuck wasting a lot of resources administering a system that doesn't really result in much actual tax directly from the application of these rules. So for the system to be sustainable, I think there needs to be a way to eliminate low-risk taxpayers from having to do those ETR calculations, particularly with respect to taxpayers operating in low-risk jurisdictions. And those simplification options outlined in the blueprint present a few ways to try to do that. I won't go into them in detail, but just in the interest of time and given that others will be focusing on them, but just walking through them, I think as a general matter, all of them have something to recommend them, and provided they're optional to taxpayers, it makes sense to advance all of them. By far, the most effective at actually meaningfully reducing complexity seems to be tax administrative guidance, and so I'll talk about that in more detail. But just starting with the CBCR ETR safe harbor, intuitively, there's a lot of appeal to being able to rely on information that taxpayers already have or already have systems to collect for country by country reporting purposes. The challenge is that country by country reporting is designed to facilitate a high level risk assessment. Expanding the purposes for that is not without its risks. And more importantly, because the purpose for which CBCR was conceived is so different from the purpose of GLOBE, it's not clear how much simplification this approach can really provide. First, because converting country by country info into something that provides meaningful help for GLOBE purposes requires you to either make a substantial number of adjustments that ultimately reduce the administrative benefit of the approach, or require adding new country by country reporting in order to facilitate the GLOBE calculation, which seems to be putting the cart before the horse. So to the extent that approach can be simplified and can avoid creating new reporting requirements solely for globe purposes. It does appear to be worth further examination, but with caution, I think, to avoid creating new reporting requirements in the interest of simplification, which ultimately seems a bit backwards. The de minimis profit exclusion, again, helpful, I think, for companies operating in large numbers of jurisdictions. I think there would obviously need to be some attention to how you calculate that de minimis amount. Are you calculating on the basis of a percentage of income? Are you calculating on the basis of a fixed monetary amount? Are you doing some combination? I think, you know, looking at a situation in which companies are in an overall loss does highlight the need for something more than a straight percentage calculation, because you don't want the fact that everyone's losing money to lead you to turning off the de minimis rule. But it does appear to have the potential to at least decrease the total number of ETR calculations that a large multinational group has to do, and that's a very good thing. Less enthusiastic, at least in over here, for the ability to apply calculations to multiple years. I think the blueprint itself did not seem terribly excited about that option as a way to achieve simplification. So I don't feel alone on that, but it also does no harm. So in that spirit, it does seem worth including as an option for people, to the extent that there are people who are helped by that. Tax administrative guidance, as I said, does seem to have a tremendous potential for simplifying compliance, and in particular, producing effectively an angel list of jurisdictions that have a broad enough tax base and a high enough rate that it makes sense to create a presumption that an M&E group's ETR within those jurisdictions is going to exceed the minimum threshold. Could carve out a pretty significant group of companies and jurisdictions without creating any meaningful additional risk of tax avoidance. Unfortunately, this is the option that shifts most of the work back to the inclusive framework to do, and I am conscious that you guys have been very busy for a very long time at this point doing this, and so it is with a heavy heart that I nevertheless ask you to keep at it, because the potential benefit to administrability is tremendous, and I do believe it can be done without creating meaningful additional risks of tax avoidance. Like any other peer review process, I think there would be the obvious potential for this to turn political and to turn contentious. The result of this process would be that M&Es in some countries would effectively have less to do than M&Es in other jurisdictions. And so if review of countries' tax systems is perceived as some sort of normative judgment on the country's tax rules, I think this, this process dies. If clear and objective measures can be agreed with respect to appropriate rate and how similar a tax base has to be to the globe rules, though, it looks more realistic, and the massive potential for simplification makes it worth giving it a real try. So I guess I'll leave it there, since I know others will have more to say on all of this, and so I want to thank you once again for the opportunity to contribute.
Thank you very much, Jesse. I'd be tempted to give loads of comments and ask you questions. I will refrain from that given the time, but thanks a lot for your insights. And without further ado, I think I'll give it over to our next speaker, and it's Catherine Harlow. Catherine, over to you.
Thank you. I'd like to thank the OECD for providing the opportunity to be part of this public consultation on the Pillar 2 blueprint today. The rules proposed in the Pillar 2 blueprint are extensive and complex, and we support the OECD's willingness today to discuss measures to achieve simplification, as it will be challenging for businesses to adopt the proposals as currently set out in the Pillar 2 blueprint. Developing the necessary systems required to implement the Pillar 2 rules would take time and involve significant costs for businesses. It's unlikely that multinationals' existing accounting systems would be able to provide the analysis proposed in the Pillar 2 blueprint without significant development. And we request that consideration is given to updating the design for Pillar 2 rules in a way that is compatible with the analysis required being provided by existing accounting systems and financial processes. Now, some of the previous panelists have already mentioned the country-by-country report, and we think that to reduce the need for wholesale accounting system changes and to minimise the burden on multinationals, we suggest that simplification could be achieved by using that report, as the country-by-country report is already an existing compliance requirement, and it can be used as a starting point for analysis as to whether a multinational is within the scope of the Pillar 2 rules. Multinationals and tax authorities are already very familiar with the country-by-country report, which contains financial information currently used by tax authorities for the purpose of tax risk assessment, as mentioned by the previous panelists. As large multinationals are required to submit country-by-country reports on an annual basis, it could be used as a gateway to determine the scope of the Pillar 2 charge for the multinational. The financial information in the country-by-country report could be used to identify jurisdictions that do not fall below the global minimum tax rate to be applied under Pillar 2. And for those jurisdictions, no further Pillar 2 analysis would be required. This would reduce the administrative burden on both tax authorities and multinationals, and allow tax authorities to focus on the small number of companies that do fall below the global minimum tax rate in a particular territory, and therefore help towards achieving some simplification. So using the country-by-country report as a gateway should bring simplification to the application of Pillar 2 for a number of reasons. It's likely that most countries that multinationals operate in will have a headline corporate tax rate greater than the global minimum tax rate, assuming that it's in the region of the 12.5% that we saw in the OECD's report from October 2020 on the economic impact assessment. In countries where there are limited risk entities who are undertaking routine activities such as distribution, it's likely that the existing application of appropriate arm's length transfer pricing policies will ensure that they will earn a level of operating profit and are taxed at a rate greater than the global minimum, and will therefore not need any further Pillar 2 analysis. It's likely that only those countries where there's entities that carry out more complex activities, including innovation and value creation, will require further analysis to assess whether they are within the scope of Pillar 2. And care should be taken even when looking at those entities which at first review appear to fall below the global minimum tax rate, as there may be good reasons why they do. For example, where there are accounting losses and timing differences faced by industries with long investment cycles, such as the pharmaceutical industry. If we are to use the country-by-country report as a gateway for determining whether a multinational is within the scope of the Pillar 2 rules, it will need to be expanded to include additional data that's not currently captured when calculating effective tax rates. This could include details of innovation incentives, such as innovation box benefits and R&D tax credits, so that they are adjusted for in consideration as to whether an entity is within the scope of Pillar 2. If such incentives are not taken into account, then this may discourage innovation. The country-by-country report could also include data on deferred tax, losses and timing differences, which would include capitalised research and development, capital allowances, pensions, timing adjustments and rollover of gains on intangibles, to ensure that these are taken into account when assessing whether an entity is in the scope of the Pillar 2 rules. For example, due to the investment cycle in the pharmaceutical industry, losses can be generated for a significant period of time before profit is realised. And looking at the existing country-by-country report data would not take the impact of losses into account. In addition, dividend income that's subject to participation exemption and capital gains on share disposals should be excluded from the analysis as to whether an entity is within the scope of Pillar 2. It would be helpful also to include the total current year tax charge, being current year, current tax and deferred tax in the country-by-country report. This would help to remove the distorting effect of timing differences where tax relief is available in a different period to the accounting period, and would provide the sustainable tax rate on which the Pillar 2 analysis could be based. So we focused on the country-by-country report, and I think there's a topic that will be raised by some of the discussants later on as well. But not only should we have tax simplification, but we should also try to achieve tax certainty. Similar to the Amount A proposal under Pillar 1, we think that a self-assessment return and documentation package, which is approved by a panel, would be helpful to obtain tax certainty over which multinationals are subject to a Pillar 2 adjustment. We also welcome the development of the dispute resolution process. It's important to reduce the number of tax disputes by eliminating unilateral measures going forwards and ensuring that the resolution of disputes is integrated for both Pillar 1 and Pillar 2, so as to definitively eliminate the risk of double taxation. We consider this is best achieved by a mandatory binding dispute resolution process, so that the outcome of any panel recommendations should not be subject to challenge by any other tax authorities once the decision has been made. If there's a non-binding dispute process, then it's likely to increase rather than reduce the number of tax disputes in the future. We'd also welcome a phased approach, which has been suggested, to allow businesses to transition into the scope of the Pillar 2 rules over an appropriate period of time. We look forward to continuing to be engaged with the OECD and contributing to the ongoing development of Pillar 1 and Pillar 2 rules over the course of this year. And thank you very much for inviting us to take part.
Thank you, Catherine. Thank you for your insights on CBC, the use of, and what we could do, and also the wider observations on dispute prevention, and also showing us not just your comments, but that the sun shines in some parts of the UK and AstraZeneca. So there is hope.
Thank you.
We turn it over to Xavier and Tanya, who are our last panelists.
Hi, thank you, Rahim. Good morning, good afternoon, good evening, everyone. So I'm Xavier Durand, I'm the VP Tax and Custom for Michelin. Michelin is a leader in sustainable mobility, 20 billion turnovers, more than 70 plants, strong presence in more than 70 countries. And we run basically 4 activities: tires, that we all know, tire-related services, such as fleet management, mobility experience, the guide, high-tech material, hydrogen, and 3D printing. Innovation is key in our company. We have more than 10,000 active patents portfolio worldwide. I will make a short introduction, then double click on the substance carve-out and tax administrative guidance, then some conclusive remarks, and then Tanya will add a few remarks. When I started to work a while ago, I clearly remember my internal clients asking each time they were contemplating an operation or a project, so Xavier, tell us what we can do, what we can't, how, but above all, please make it short. Now, some internal clients are begging, please make it understandable. Business must grow friendly in a friendly environment and above all, understandable. Bureaucracy and complexity kill agility. We as MNEs should help, ease and support any initiatives that will make our tax world more sustainable, there is no doubt. This is not a nice to have, this is a must. And we highly appreciate to have the opportunity to co-construct this world with the OECD and relevant public authorities. What is at stake here? International harmful tax competition and tax regime, which we believe are not sustainable accordingly. How to improve that? Easy answer would have been to ask the relevant authorities to press the usual suspects to adapt their regime. But the journey is slightly different, as we want to rely on MNEs to make it happen. The struggle of companies is to find markets, to develop, to grow, and to survive, unfortunately, these times. Fighting against harmful tax regimes on the international stage should not be the fight of businesses, but the reality they should embrace and adhere. When I was explaining my business people the CFC rules, it was hard for them to understand. Now that I have to explain in addition the GILTI rules, it's harder. If tomorrow I have to explain another cumulative restriction globe, it will be much harder, almost impossible. The main victim will be the agility to run the business. That said, our common goal is to make it happen, but taking into account the urgent need for M&Es for simplification and less bureaucracy. With respect to the substance carve-out, the goal of the substance carve-out is to safeguard that income of taxpayers having an ETR lower than assumed, who fulfill certain conditions regarding their economic substance. It will be excluded for minimum tax purposes. We fully support this proposal. We consider that the economic substance relates to both tangible asset components and intangible asset components. The complete recasting of the international tax principles results mainly from the role of intangibles in the value process creation. It's true for pure numeric players. It's also true for the industry. Every single acquisition highlights the predominance of intangible through the PPA. It's a reality we need to consider. The carve-out should then build on the tangible and intangible components, easiest way to stick to the reality. If not possible for reasons we would need to understand, one should explore how to take into account the intangible dimension through the personal cost as being part of the tangible component. But this will unfortunately lead to complexity we aim at avoiding. Finally, as we have commented in our written submission, M&Es groups should be allowed to take data in consolidated accounts in order to avoid any adjustments. Tax administrative guidance now. We do believe we have here a very efficient way to simplify the implementation of this minimum tax. Co-constructing the framework of this new constraint could allow both OECD and M&Es to reduce instances where a huge preparation is required, as well as a deep review by the administration. It would make sense that the inclusive framework's responsibility is also to deal with this issue within a government-level process. It is a matter of fairness towards business, which would otherwise bear the whole burden of this fight. The idea is simple here. The simplification measure would establish an ex-ante process whereby tax administrations would identify positively, in our view, that would be a whitelist, together with the stakeholders, jurisdictions, which have an acceptable tax base and tax rate for global purposes. Those M&Es would enjoy in presumption that their ETR in that jurisdiction exceeded the agreed minimum rate. How to put in play the process? By relying on objective criteria. One could consider, for example, that the existence of a CFC rule in the said jurisdiction could constitute a good starting point. This would recognize the efforts already carried out by certain jurisdictions to fight undertaxation. This simplification measure aims at avoiding useless work and extra compliance burden if we already have in place a regime that guarantees that the contemplated situation does not fall within the harmful tax practice. This whitelist process should be designed hand in hand by government and business, for example, with a business advisory group. The running of this process could be under the responsibility of the OECD. In order to create an incentive for jurisdiction to participate, it could be designed as a non-mandatory one whereby jurisdiction could participate on voluntary basis, at least in the first years. To conclude on this topic, we believe that administrative guidance should be implemented as a matter of priority, and we of course stand ready to support the inclusive framework in this respect. Conclusive remarks from my side. Group like Michelin design more and more often their business and their activity from a global perspective, a worldwide approach, and no longer relying on a mere geographical footprint. Tax authorities focus on local geographies and local contribution, especially for the digital economy. International and local tax rules do not recognize group as a taxpayer, but consider, on the contrary, that the mere existence of a group is dubious tax-wise, requiring a stronger and deeper control, which we can understand. M&S Group must demonstrate and substantiate that they respect the business purpose on every single country where they operate, and that they spread correctly, meaning fairly, their profit among them. This paradox, which is linked to the way the business is conducted nowadays, leads to huge work and a lot of effort for the group through their tax expert to declare, tax, and report the relevant profit in the various geographies M&As operate. We have already to play with various standards, local GAAP, IFRS, and we are already facing difficulties in bridging the gap. We then recommend to rely on what does already exist, to avoid creating new standards, and to simplify to the extreme this new burden to avoid negative impact on the growth of their activity. The co-construction approach is highly appreciated and appears to be the only one to make it happen. Tanya?
Thank you very much. I hope you can all hear me. Thanks a lot, Achim, and thanks to the Inclusive Framework. My name is Tanya Saulnier from MEDEF, the largest business organization in France. I will simply add a few comments to what Xavier has said. On simplification options, I would like to clarify that all the options described in the blueprints should be available because they could all be useful to many groups depending on their situations. But what we say is that they should be a priority and they should be further refined. There should be hand-in-hand work on the tax administrative guidance, which should be the top priority. I would also like to remind that MEDEF back in December 2019 had proposed a solution based on a gateway test where we wanted to exclude many groups which had ETR above a certain level, for example, 20%. So this is different from proposing a global blending, although of course it has some echo to the US GILTI rule, but it still allows the jurisdictional blending to work when the ETR is not good enough. Importantly, this simplification that we had proposed would allow tax administrations to focus on those M&E groups with lower ETRs. So we believe this is still a very valid option, and we ask for further reconsideration of it. So now, why do we insist so much on simplification? I think it was said before. We believe that over-complexity has now been reached, and we really think that this is a problem. And let me just give you an end with these very high-level comments. Why is complexity a problem? It is a problem because it creates critical risks. First of all, because the top priority today for businesses and governments in the coming months will be to recover from this severe economic crisis due to the COVID-19 pandemic. This means that everyone will have to focus resources on resilience and pro-growth projects. Avoiding complexity is also critical because a good tax system is that one that can be easily understood and easily controlled. You need to avoid risks of litigation. You also need to avoid criticism from civil society when there is insufficient tax control. And this is of particular concern for developing countries. So this is why we would like the inclusive framework to reconsider some main issues. And I will just end up with these 3 points. Number one, please allow the use of deferred tax accounting. I think Anne-Marie said it all. There are probably ways you could work on safeguards in order not to weaken the policy objective. Second, we want to use the data from the financial accounts, but without adjustments. Our concern is really here, as Xavier said, to avoid the creation of a whole new standard. And last, because of the inextricable complexity that will arise, we really call for the postponement of UTPR and STTR. They should only be considered, I'm not saying they should be applied, but I'm saying they should only be considered after a probationary period. But I think that will be for the next panel. Thank you very much.
Thank you, Xavier, and thank you, Tanya. We are running slightly over time, but that's okay because I can tell John to shorten it, or otherwise, maybe we can run a little longer given that we don't need to go anywhere. So we might be running slightly over time, but I think the insights, the comments, the observation, the diversity, I think does justify to take the time. I will perhaps then also just invite John at the next panel to maybe have a little comment on, as I said, also in response to Anne-Marie and in response to you, Tanya, on where is the working party also on the deferred tax accounting, some of the reflection to give a full color, I think, on all sides to this very important issue. So thanks a lot for these comments. I'm handing over now for shorter interventions, but nevertheless important interventions that will highlight particular aspects. I think our first discussant is Jane, who will focus a bit on carve-outs and give us her perspective on the carve-out topic. So the floor is yours.
Great, thanks very much, Hakeem. And first of all, I just wanted to, I think you might have inadvertently promoted me in my introduction. I'm head of UK tax, not head of global tax. So I thought I'd better clarify that before my boss intervenes. Indeed, they're the ones that matter. So just a bit of background and context to my comments. So GSK, we're a science-led global healthcare company, and innovation is central to our purpose, and particularly innovation in medical R&D. So in 2019, we invested 1.4 billion in biopharmaceutical R&D. And we really recognise and are supportive of the work done by the OECD to date. So thank you all very much for that. And we're very grateful for this opportunity to participate in this consultation. We're very aware that tax is one important aspect of the contribution we make to society. So we're very supportive of a sustainable tax system that enables both companies and citizens to thrive. And we acknowledge the OECD's efforts in this area. Taking the Pillar 2 specific aspects, we believe there's two key outcomes that should be considered when revising the international tax framework. And firstly, that the framework should create a fair foundation for taxpayers and governments, and that any tax regime should be based on clear and rational principles that recognise how different industries generate value. And it should be possible to apply these principles clearly and consistently across different business models. Our second key outcome is that the tax framework should enable innovative research and development, R&D, to support economic growth and, in the case of the pharmaceutical industry, the wider health, social and economic benefits that stems from our R&D. As Catherine already mentioned, biopharmaceutical businesses are built on the discovery and development of new medicines and vaccines. And it's critical that the OECD's proposals take account of business models like ours, which rely on upfront investment in high-risk R&D, and where the period from investment in R&D activity to the actual realisation of profits can be a decade or more. And there are several aspects of the proposals where the application to industries with long investment life cycles needs to be considered to ensure that the rules operate fairly and do not render certain taxpayers subject to tax liabilities in excess of their economic position, simply due to their industry or stage of life cycle. In addition to the formulaic substance-based carve-outs, which I'll come to in a moment, the unlimited recognition and carry forward of losses, both pre-regime losses and in-regime losses, is critical in ensuring the proposals don't render certain taxpayers subject to tax liabilities in excess of the economic position simply by virtue of their investment life cycle and in position in it. And in this regard, we'd also be very supportive of the deferred tax proposals Anne-Marie was putting forward earlier as what should be a relatively simple means of ensuring that these discrepancies don't arise. But turning now to the substance-based carve-outs, we believe these are a key factor in supporting investment in economic growth. And they do this by ensuring that companies can achieve a base level of return for their investment in substance-based activities, such as employees, without this being adversely impacted by Pillar 2. And there's two key factors I think believe we need to be considered. But I'll come first to the point Joachim made earlier around the adjustments to cover taxes and how that might work in practice. Because I appreciate the theory of what he set out around it being equal to adjust both the profits and the covered taxes. But that would be very, very difficult, if not impossible in practice, and could lead to some quite distorted results. And that's really because the formulaic substance-based carve-outs are in fact a proxy for the return on that investment. They're applying a fixed return to that investment, and to calculate the profits generated. When you then come to the actual taxes that a company has paid on those profits, that will be vastly different and will depend on a number of factors. It would depend on the actual return the company's generated on that investment. So, for example, if you take payroll, in our industry, a lot of our payroll is in R&D employees, and we generally allocate a very high return because they're very specialist employees driving a lot of value. You might compare that to a more routine industry where employees are doing more routine activities, and they might actually generate a lower return. So the formulaic substance-based carve-out will be a proxy for all those situations. So the return being allocated to that activity will differ vastly from what's being achieved in reality. And then the actual tax position on those profits in reality will also be an interaction with all the other activity that a company has going on in that country. And there will be interactions between the different tax profiles of different activities Therefore, I think it would be a very, very difficult, if not impossible exercise to work out what tax is paid related to the profits that have been carved out under the formulaic substance-based carve-outs, and to make an appropriate adjustment. And with regards to the policy intent, I think there'd be a very, very low risk of those formulaic substance-based carve-outs, given just the low routine-based return they're protecting, kind of achieving a distortive manner in the way Joachim set out. Covering on to, but as I mentioned, we're very supportive of the formulaic substance-based carve-outs. We think they're important in supporting innovative R&D and wider economic investment and growth. And for us, there's two key factors that need to be considered. One is that the carve-outs should reflect all the investment made throughout the product life cycle. And as noted before, a key principle for us is that any tax regime is based on clear and rational principles that recognise how different industries generate value. And this is particularly important for industries with long investment life cycles, such as the pharmaceutical industry, where we can make significant substantive investments, such as in R&D employees, over a 10 to 15 year period before a return on that investment is generated. And it's therefore important that the carve-outs acknowledge all of this investment that has been made in a jurisdiction over the entire investment life cycles. If they fail to do so, the regime could potentially undermine investment in high-risk R&D in innovative medicines and vaccines, and the health, social and economic benefits this can bring. And this could be prevented and ensure the carve-outs operate effectively in the case of industries with long investment life cycles, by allowing for them to be calculated by reference to substantive investment made in any year. And then where a carve-out is not used in a particular year, for example, because a company is in an overall loss position, as it is still in an investment phase, that unused carve-out could be carried forward and used in such point in time as profits are being generated. And that would have the effect of matching the timing of the carve-out with the return on the underlying investment, and ensure that a base level of return for all substantive investment that is made is protected. And the second point that's key for our industry is that the carve-outs reflect the modern R&D ecosystem. And the modern R&D ecosystem is diverse. Whereas previously we'd have a huge number of people in a laboratory, we're now really much more outwardly engaged and integrated, often engaging with partners for key R&D inputs, such as laboratory consumables, or access to specialisms and expertise, which we maybe don't have. And these often take the forms of collaborations with universities. And these types of activities incur third-party expenditure, which is really integral to the R&D activity being carried out by the employees on the ground. And these types of ecosystem and flexibility of business model are vital in driving innovation and the resultant healthcare and economic benefits. And the carve-out should acknowledge and incorporate this wider investment in order to ensure that the tax system continues to facilitate innovative R&D. And to ensure any third-party spend included in the carve-out is aligned with local substance, a check can be put in place by capping the amount of third-party expenditure included in the carve-out by reference to the amount of payroll and fixed asset expenditure. And if these two factors we've outlined are borne in mind, we believe that the carve-outs can contribute towards the outcomes of creating a tax system that provides a fair foundation for taxpayers and governments, and that enables innovative R&D and the economic growth that it supports. And thanks again for inviting us to share our comments, and we'll be happy to discuss further anytime.
Thank you very much for coming in, and also thank you that this discussion is unfolding in quite an interesting way, that we had Joachim coming with one point, you adding another dimension. I think we've also seen this with Tanya on adjustments and Jesse. So thank you for giving color and liveliness also to the panel, and thank you for your observations themselves. I turn now to David Murray. I will not spell out your title because otherwise I will inadvertently maybe promote you as well. But I turn over to you, and I think you had reflections in particular on the CBCR simplification and how perhaps we can make it work.
Thanks, Hakeem, for the opportunity to speak. Like Jesse, I was pleased to blow the dust off the old shirt and tie, but it turned out not to be that uplifting an experience trying to do the collar up this morning after 9 months stuck at home. But we are where we are. So I'm here today representing a group of members of the Tax Executives Council of the Conference Board, which is made up of senior tax executives from a number of geographically and industrially diverse businesses. Many of our members fear that the current proposals don't quite achieve Pillar 2's broader objective, particularly in the areas that Anne-Marie has highlighted, so capital-intensive businesses with big upfront spend that can be particularly adversely impacted regardless of how highly they might actually be taxed. So I think our response and I here today would endorse Anne-Marie's position on that aspect. But as Achim said, we've been asked to explain our proposal for a CBCR ETR safe harbour. I agree with what Catherine said about the key objectives and challenges of a CBCR simplification procedure. And I agree with the logic of a gateway proposal that she outlined. It's not philosophically dissimilar to what we're proposing, trying to remove as early as possible the number of entities or jurisdictions that you need to suffer this deep dive and really limiting it to those which pose the highest risks. Where I think ours is different is in terms of the mechanism of achieving that objective, because our proposal doesn't focus on substance. That said, I think it's fair to say we do support any and all simplification measures and mechanisms that can be agreed, even if they don't help every business. I think they're all a step in the right direction. So I'd like to cover off 4 key points or KPIs of our proposal, and I know we're pushed for time, but I promise the third and fourth are considerably shorter than the first 2, so there's no need to panic. That the first one is a little longer. Our first key point is that simplification must carve out jurisdictions at a very early stage of the calculation, based on existing data with minimal adjustments. And in practice, we think this means using the CBCR report as the base data set. However, because of sort of differences in the data and systems, we could find no useful amendments that all businesses would easily be able to make to get us to that point, which was quite a depressing conclusion, actually, because we thought quite hard about it. But I was then pleased to hear that Jesse had reached the same conclusion, because this would now be quite an embarrassing presentation if he had had a silver bullet to that problem that we haven't had. But at a very high level, our proposal to address this challenge is quite simple. Instead of adjusting the profit or the tax numbers on each line of the CBCR to unwind the biggest risks, we could instead adjust the minimum rate being applied to each line of the data through applying multipliers to the globe minimum rate itself to reflect the risks that are inherent in the data that is available. And we do have one slide. If that could go up, that would be great. Thank you. We discussed 2 theoretical ways in which this could be achieved, as are shown on the slide. I should say up front, the multipliers included on this slide, they're not scientific, they're just there to demonstrate the idea. First approach would be through a flowchart style approach, where adjustments are made sequentially and a different threshold rate is applied after each adjustment. I think this would be relatively simple to design. The challenge with this one is that it would discriminate against lots of businesses who might not be able to easily make the first or the second adjustment, and it would really serve no purpose to those businesses, even though you could design it in such a way as the earlier adjustments are the ones that help the most businesses. Second, a more complex array of multiples could be calculated to really allow for a sort of full suite of different adjustments to be chosen from, and an appropriate risk-based rate applied depending on which combination of those adjustments were applied. So clearly this is more complex in design than the flowchart solution, but it would give much more flexibility and be useful to many more taxpayers in practice. And we think that front-loading that complexity into the design phase would give benefits in perpetuity in the application phase. Clearly, it's not intended to exclude every jurisdiction that would have no inclusion, but it could provide a basis for excluding those where it should be pretty obvious there should be no inclusion once the detailed calculations were done. Our second key point is that it must allow timing differences to be taken into account to avoid jurisdictions that jumping in and out each year. In practice, that probably means that deferred tax would need to be included as one potential adjustment. And of course, that would give the data a different risk profile and a different multiple, maybe a higher multiple. But that's really a question of risk rather than a question of process. So to sort of put this into context, give an example. You might have, say, 4 examples. One adjustment allows a group to bring deferred tax onto their CBCR. Another allows reallocation of CFC taxes. Another might strip out non-taxable income, and another might add back non-deductible expenses. And each different combination of those adjustments would have a different risk profile, and thus be subject to a different multiple based on the minimum globe rate. And then groups could identify which adjustments of those four they could easily make, and the rate could automatically be flexed to reflect the risks that would be inherent in the data they could easily get to. I think quite an important point is to ensure that this sort of simplification array could not be used for avoidance, which I think speaks to the concerns that some of the NGOs raised in their responses. And I'd make two suggestions on that. The first is that groups should not really be allowed to apply some combination of adjustments to some jurisdictions and then another different combination of adjustments to other jurisdictions. You should choose the adjustments that you can make and stick with it for all jurisdictions. And second, if a jurisdiction is excluded through this simplification mechanism, the tax that is allocated to it, so for example, it might include some CFC tax that wasn't reallocated because that was all too difficult. You shouldn't then, when you do your full globe calculations, be able to take that tax back out of the jurisdiction that's already been excluded, because that would then be double counting the tax. So I think we can probably remove the slide now, and I can finish up quite quickly. Our third key point would be that really this does require quite a lot of engagement with the broader business community to identify which adjustments should be included in the regime, which are the most important, what the risks inherent in them might be, and the inclusive framework members too would need to agree the multipliers. So and maybe looking at existing CBCRs and where existing risks are and what impact that actually has on real CBCRs might help in demonstrating what appropriate multipliers could be. And our fourth and final point is that a de minimis threshold should be applied to the PBT of each jurisdiction at a CBC level in percentage terms. And that should really be separate of this proposal. It could be built into this as one of the adjustments or one of the things to be taken out, but it needn't be. It should be included in some way, shape or form, regardless of the success of this broader proposal. So I won't reiterate all my key points to save a little bit of time, but I will finish by thanking the OECD for the opportunity to speak. We think that principled and coordinated multilateral solutions really have to be found for these challenges, and we stand ready to engage further to discuss this proposal or any others that might help alleviate the administrative burdens and over-taxation of businesses. Thank you.
David, thanks very much. Thanks for the insights, thanks for the comments, and thanks for distracting us by looking at your guitars in the background. So thanks a lot for coming in. I think we finish off with our last discussant. It's Paul, I think, who speaks for the insurance dimension, where we recognize that given the regulatory, statutory accounting, consolidated, that there are particular issues that I think the insurance industry has brought to us. And so I would invite him to just give us a flavor of some of the insurance industry specific issues that have been raised by you, but also by others. So the floor is yours.
Thank you for inviting me to speak, and speaking on behalf of the Insurance Company Working Group on BEPS, an EY organized group of global insurance, reinsurance companies with participants from North America, Europe, and Asia, the membership for which is in our OECD submission. I very much appreciate the opportunity to discuss the Pillar 2 blueprint and the application of the Globe ETR calculation to global insurance companies, and will focus on the following points, many of which have been made about the ETR calculation that uses current tax over financial reported income, which does not work for insurance companies. It does not work because of material systemic timing items that are a core part of the insurance business. These timing differences include the calculation of insurance reserves, the capitalization and amortization of acquisition or sales costs, and the accounting for investments. Given the long-term nature of these timing differences, the carry forward and other mechanisms to avoid double taxation will not be effective for the insurance industry. Therefore, to avoid double tax, we need to either use deferred tax accounting or make targeted timing adjustments to the Globe ETR. The Inclusive Framework recognizes that the insurance business is unique, as explained in the Pillar 1 blueprint, that the measurement of profits in the insurance sector is not comparable to most industries. As we heard already, other industries incur costs at an early stage in their business cycle with corresponding revenues generated later. The opposite is true for many insurance companies, where insurance companies collect upfront premiums, and then we have profits. We have upfront premiums, which are our profits early on, and then we often much later will pay claims. This creates a multi-year business cycle unique to the insurance industry. Current year profits are based on insurance reserve estimates that reflect losses that may or may not occur and are based on complex actuarial modeling techniques. In addition, it is very important to understand that the profits of an insurance company are heavily influenced by accounting for investments held to pay future promises in the form of claims. Therefore, for insurance companies, the mechanism included in the Pillar 2 blueprint to compute the ETR that has current tax over financial reported profits creates fundamental inaccuracies in the ETR calculation that will expose the industry to the IR, the UTPR, as well as the UTPR proposed to be imposed on ultimate parent entities located in high tax countries where income is otherwise properly taxed and no base erosion is occurring. Unless changes are adopted, this will systemically result in double taxation, which again, the carry forward rules do not address. We therefore strongly recommend the use of deferred tax accounting to determine whether multinational insurance or reinsurance companies satisfy the minimum rate threshold. Again, if full deferred tax accounting is not adopted, then changes to the ETR fraction must be adopted to eliminate the most material timing differences for insurance companies. Anne-Marie talked about long-lived assets. We have long-lived liabilities. In the non-life sector, there are companies still paying asbestos claims from the 1970s, and I think I don't need to speak about, we all hope that life insurance companies have very, very long-lived liabilities. While we very much appreciate and applaud the Pillar 2 blueprint recognition that deferred tax adjustments must be made for depreciation, which may be among the most material and common systemic timing differences for the global industry, depreciation is not material for insurance and financial service companies. We agree that the proposed method to adjust for depreciation timing differences is appropriate and represents a correct approach to address such timing differences. We suggest that similar adjustments be adopted for at least the three most material timing differences for the insurance companies, which I've mentioned are reserves, capitalization, amortization of acquisition or sales costs, and the accounting for investments. These rules are dictated by our regulatory, accounting, and tax laws. They are out of our control. Unlike accelerated depreciation, which the blueprint allows a form of deferred tax to calculate the global ETR, the timing differences we face are not based on tax incentives and are provided by not provided as elections by jurisdictions. These timing differences are built into our business model and are prescriptive. Finally, I'd just like to also mention one permanent difference that is very material for insurance companies, and that is dividend exemptions or dividend received deduction rules. Those rules are in tax laws in order to avoid double corporate taxation. They are very material for insurance companies, as insurance companies are among the largest investors in the economy. We believe that the adjustment for local tax laws that allow for dividend exemptions or dividend received deductions should be taken into account in the global ETR to the extent allowed in the tax jurisdiction without any threshold. It would be unfortunate if adjustments to tax bases that are intended to avoid double taxation cause insurance companies to be below the globe minimum tax rate and thus cause companies to be subject to double taxation. Again, with regard to the timing differences, we believe there is an easy fix, which is the application of deferred tax accounting or adjusting for easily identifiable timing differences. We don't think this will create complexity. We all prepare financial reports. We all have in our footnotes very clearly stated those deferred tax items and timing differences. So we very much appreciate the thought on this, and thank you very much for the time.
Thank you very much to giving us also the take from the insurance perspective and some of the specific features and implications that some of the rule parts might have on the industry. I think very good to round off the picture. I think we're out of time by quite a bit of a margin, so I will finish this panel, not without thanking all of you for your contributions, for your comments, for your insight, and for the, I think, lively and active discussion that we're able to have. I certainly learned a lot. We will take it away, as we said, also into the working party to consider all of these issues. I will turn it over to John with perhaps 2 comments, whether there is time, whether John can give you a sense a little bit from the working party on where the discussion on deferred tax accounting is, and give you a fuller picture if time permits. And then also we are looking at questions as they're coming in. So if we have into the next panel, at that point, we would then come to questions that are emerging from the audience. So we just need to see how we go. But in the meantime, thank you to all of you, and over to John.
Okay, thank you, Achim. And if I turn back to the question of deferred tax accounting, or at least sort of provide you, as you said, with a perspective on where we're coming at this from a working party perspective. I won't reiterate what Anne-Marie or Paul or others have said on deferred tax accounting. I think the concerns that they raise are valid and they are recognised. And some of those questions have been extensively discussed in the working party already and gave rise to the types of approaches that are set out in the blueprint. There are some new ideas in the submissions that we want to think about, and we wanted to give some more time to. But I think it would be helpful if I could sort of perhaps articulate what the challenge is from a deferred tax accounting perspective, at least from the working party perspective. And it goes back, in fact, to the dichotomy which a number of you have identified, which is, yeah, it's true that, Globe compares financial income against a local cash tax base. That's what happens, and that's what's giving rise to the period-by-period differences that we are identifying here. But the reason that local tax cash is the preferred measure, or is one that is attractive to the working party delegates, is because that is the actual tax that is paid under the laws of those jurisdictions. And what a deferred tax accounting approach would do is to allow the M&E to claim a credit, effectively, not only for accrued but unpaid taxes, but in fact for tax liabilities that are expected to arise in the future, effectively granting an expected, allowing an expected tax liability to be credited against a current obligation to pay. And there really isn't any models, at least that have been brought to our attention by our 135 inclusive framework countries that we're aware of, where tax systems currently do that. And so when you sort of pause to think about what the implications of doing that are, the first is, of course, that you are providing the taxpayer with a time value of money benefit in relation to the deferred tax portion, thereby creating, effectively building into your system from the beginning a preference for deferral as a tax system design. And we'd have questions in our own mind about whether that is the correct approach if we're sort of setting what the standard needs to be here. There's also concerns that we would end up providing in certain cases taxpayers with the benefit of long-term or indefinite deferral on certain items. So it sort of in one sense goes to beg the question which Anne-Marie put out at the beginning, which is to say, are we comfortable that, that any period of deferral that we are comfortable with? And I think the idea behind that is not necessarily. So there's some concerns at the working party level around the prospect of long-term and indefinite deferrals, other than in relation to specific items. So I think that it's clearly flagged in the blueprint that capital investment in capital assets is an area the working party has identified as meriting special concern, and we've seen the concerns raised by the insurance industry, and we're taking those on board. So there may be a number of items where we can see that there is a reason, a structural reason, or a good tax policy reason for why those long-term or indefinite deferrals are occurring, but is it in all cases that we're comfortable with long-term or indefinite deferral? And I think there is some concern in the working party around that. There is there's also, because this is not a memorandum account based system, but a system that's essentially based on the calculations that are made at the financial accounting level, there is some concern from a tax administration perspective that this is something of a black box for them in terms of their ability to understand and audit these numbers. And then I think that finally, and this is perhaps where this conversation now starts, given the benefit of the public consultation that we have had here and the concerns that have been raised, and I think it's certainly incumbent on us to go back and look at these issues afresh and try and understand them better. The question is whether deferred tax accounting itself is going to, doesn't have its own incomplete solution in relation to some of these problems. I mean, what would we do, for example, in relation to loss carry forwards in low tax jurisdictions where there's no corresponding deferred tax item? How would we deal necessarily with that design element if that was something that we sought to preserve in the design of the rules? What do we do and how do we cope with changes in expected tax liabilities that may take place in future periods in the absence of a carry forward mechanism and an agreed policy around a carry forward mechanism? So there are sort of, I think, if we go through and they think about the logic of the deferred tax accounting, there are some questions some follow-on questions, in fact, that the Working Party will have for business as it starts to think about what the implications of this type of approach would be. And I think the important message here is this needs to be perhaps the starting point for a dialogue and a testing of how these models could work so that we are comfortable and everyone is comfortable that we've arrived at the right decision for the right reasons. So I think that's very useful to have this input. And we will take it on board, and we will be reaching out to you as the consequence of the submissions that you've raised. Some have also been raised on the chat, and we anticipate that this will be part of the ongoing discussion that we have with the Working Party, but also with stakeholders. So thank you for that. I want to turn now to the second part of the panel presentation. I'm not going to do an extensive introduction. This part of the panel presentation really focuses on what you can think of as the charging rules for the Globe proposal. We have the rules for determining and calculating what the amount of the tax is, but these are the rules that determine where and when such taxes become payable. And the key focus of the blueprint, as you're aware, is trying to get rules that operate in a comprehensive way, given that these rules are operating potentially in multiple jurisdictions at the same time, to make sure that they're well coordinated and that they're mechanical rules that are going to provide for clear and certain outcomes and avoid the risk of overtaxation. No small challenge there, given the underlying complexity of the existing international tax system, and then the need to design an overarching system that sits on top of that, which accommodates all those existing tax features, but nevertheless results in those kind of outcomes. And I will turn, I think, the floor over to Dr. Ulrich Sauter. He is from the global head. He's the global head of transfer pricing at Novartis, and is here to speak to the submissions made by Swiss Holding, particularly on the application of the IIR, with a focus on the top-down approach, the coordination, and the rule order that's set out between that rule and the UTPR. So, Ulrich, if I could ask you to take the floor.
Thank you, John. Thank you, Mr. Scheer, for receiving the opportunity to share our thoughts. Swiss Holding is a Swiss-based business association for which I speak, as you said in the beginning. Such public hearings are very welcome by us, as it is an excellent opportunity to share views in a wider forum and to support the development of this critical initiative. As you laid out, John, I'm asked to speak about the top-down approach and the rule ordering. But please allow me first to set a bit the scene before I will dive in answering these topics. If new compliance measures are imposed on MNEs, then MNEs need to strive for simplicity in the internal process, the minimization of potential disputes on double taxation, and of course, cost efficiencies are key. The entire Pillar 2 calculation presents a process which will regularly repeat, which requires a solid financial accounting and tracking of a Pillar 2 tax paid, respectively credited. It will become a nightmare if it triggers endless disputes and double taxation. This is the challenge to overcome. The solution is simple in our view. The fewer the internal and external contact points to gather data, the fewer the adjustments to be made, the clearer the base, the stronger the efficient process can be. A strong and efficient process ultimately leads to lower disputes and less double taxation. Based on this view, let me quickly go through the different rules proposed. And I start with the subject to tax rule, knowing, yes, there will be two panelists speaking about it later on. Therefore, I will keep my remarks very short. From our point of view, this rule is the most inefficient rule, as it is treaty-dependent and transaction-orientated. Detailed knowledge of each treaty and on each included transaction is required. Differences in the interpretation of specific transactions between taxpayers and tax authorities and the tax authorities are almost certain. However, I will stop here because this discussion will be deepened later. The under-tax payment rule is slightly better than the subject to tax rule. To avoid different unilateral rules, we hope for one single definition and a harmonized coordination process aligned to the agreement with the OECD. I fear this might stay a dream. The under-tax payment rule requires the tracking and tracing of every single payment involving the low tax jurisdiction. All tax authorities linked to the low tax jurisdiction want to cash in their share of the Pillar 2 tax. After any payment, there is the need to track the related tax credits and reconcile them on an ongoing basis, as the M&E wants to benefit from a potential relief in subsequent years. Such a process requires the involvement of tax authorities receiving the payment and the group entities which made the payment in an ongoing annual reconciliation process. This requires a tremendous coordination work between the different group entities and the different tax authorities involved in the transaction with a low tax jurisdiction. Managing this complexity across all involved jurisdictions and entities asks for dedicated teams in the NNE and reliable processes at the involved tax authorities. For sure, a setup with so many different connection points will always lead to glimpses in the communication, process errors, disputes, and in the end, double taxation. Looking at Novartis as a Swiss headquartered group and as Switzerland to the proposed 12.5% is borderline, we fear that Switzerland might become such a low tax jurisdiction. Our headquarter entities of Novartis have financial ties with all subsidiaries globally. The under-tax payment rule would require us to coordinate the Pillar 2 tax between at least 70 countries and potentially track the payments as credits for years until we can claim them back. This keeps the team busy just with coordinating the process and will for sure lead to a certain number of regular disputes with the involved tax authorities and potential double taxation. In our view, the only rule which truly allows for a global, centralized and coordinated work is the income inclusion rule with the top-down approach, as it is truly a comprehensive rule. With support of a centralized financial accounting team and a global process, the data required for the income inclusion rule can also be centralized, gathered and analyzed. The number of adjustments to the data is limited and could be performed by a central team, which is cost efficient. The income inclusion rule allows the ultimate parent entity to deal with one counterparty, which is the tax authority of the ultimate parent entity jurisdiction. It is a more targeted rule as it is levied on total global on total profits and not on a single payment stream. Based on global data collection, the fewer adjustments to the data and the profits as base, an audit performed by the ultimate parent tax authority should be easy and straightforward. With the income inclusion rule, tax credit mechanism, which only needs to be reviewed and agreed by the ultimate parent tax authority, the carried forward mechanism is simple and less error prone. A simple, efficient process between a few parties will cause very little disputes and as a consequence, hopefully cause no double taxation. Already the idea to split the process for only partially owned subgroups is a tremendous complication, which leads to an exponential cost and resource increase and might cause double taxation. The M&E's expert team requires data in form of sub-consolidations, liaises with teams in the subgroup, and works with local tax authorities in the subgroup's parent jurisdiction, which has for sure different requirements and forms compared to the ultimate parent jurisdiction. In addition, several tax audits are required by the tax authorities, need to perform independently. This is a big step away from a simplified process. In summary, we plead for rules that allows the simplest and most efficient process to keep the burden on cost and additional resources the lowest, and as consequences, reduces the number of disputes and the exposure to potential double taxation. From our point of view, the only rule which allows such a lean and efficient process is the income inclusion rule, with a single test at the ultimate parent entity. Any deviation will exponentially increase the compliance burden, and with that, the cost of any NME, as well as risk of disputes and double taxation. All other rules to be implemented beside the income inclusion rule should only be regarded as a measure to close certain gaps. In case there is no agreement by the Inclusive Framework members to only test at the ultimate parent entity level, then we propose to limit the test at the sub-consolidation group to subgroups with a significant minority interest. These minorities should at least account for 10% of the equity ownership. From my point of view, it could even be higher. Thanks for providing me the opportunity to share my thoughts, and thanks for participating in this panel.
Very much, Ulrich, and certainly good to hear. I think you did an exceptional job of setting out the layered complexity associated with these rules, and in fact sort of articulated one of the key design thinking behind the rule order, which is not necessarily to preference one jurisdiction or one type of jurisdiction or the other, but really to find a rule order that is going to prioritize ease of administration and compliance in relation to these rules. So thank you, a very helpful submission. One of the key issues that you identified, I think, at the end of what you were saying is the one that emerges from the design of the income inclusion rule, is how this rule would apply to partially owned intermediate entities. And here to talk about this aspect of the income inclusion rule, please have Pierre-Antoine Cléty from Loyens and Leuf, who made some submissions on this question. So if I could pass across to you, Pierre-Antoine.
Thank you, John. I hope you can all hear me. Okay, so you've asked me to speak about the split ownership rule, and thank you very much for the opportunity to participate. Maybe just to set the scene, especially for those who would be watching without having studied as much as many participants the proposal. The split ownership rule is a derogation from the main income inclusion rule. So, as was just explained by Ulrich, normally under the income inclusion rule, you would have the top-up taxation applying at the level of the ultimate parent entity of the group. However, the proposal also says, well, if the low tax subsidiary or constituent entity is not fully controlled, but the UPE, so the ultimate parent entity, has less than, for example, 90% in the low tax constituent entity, then we should consider applying the inclusion and the top-up taxation at the level of the partially owned intermediate parent. Why is this proposed? Well, I think the purpose of this rule is to avoid the circumvention of the income inclusion rule in as many fact patterns as possible where there are direct or indirect minority shareholdings in a low tax constituent entity. The thing is, however, that in the report we have several derogations, not just the partially owned intermediate parent rule, but we also have a simplified income inclusion rule, which applies to associates and joint ventures and is covered in Chapter 8 of the report. So our main concern that we wanted to convey is the risk of complexity and overlap of the rules. And then we wanted to raise in our submission and also in this oral contribution now, how could we possibly resolve that? How could we bring further simplicity to mitigate the risk of increased disputes and also avoid that the compliance costs are such that they outweigh the benefit of the rule for tax authorities, and also avoid that compliance costs for excessively complex rules dissuade MNEs from being accurate because it's easier to pay too much tax than to have all the detailed compliance effort undertaken. So do we need all this complex set of rules, or can we maybe facilitate the interaction, and can we make the simplification proposals more effective? And for that, the first thing I would like to look at is how the split ownership rule and the simplified income inclusion rule for associates interact, and whether we could not possibly drop one of the two and just apply the other. And we ask this because if we have all the rules that are currently proposed, well, then we have the ordinary income inclusion rule when the MNE group has at least, say, 90% of the low tax constituent entity. Then if the stake of the MNE group falls below 90% of the rise to profits in the low tax constituent entity, we need to consider applying the income inclusion rule at the level of the partially owned intermediate parent under the split ownership rule. And if a minority investor now happens to have at least 20%, and therefore the controlling MNE group has 80% or less, then that low tax constituent entity may qualify as an associate of the minority investor, and the simplified income inclusion rule also comes into the game. So on the one hand, we could say, well, maybe we can just apply the split ownership rule, because if the minority investor invests through the partially owned intermediate parent, there should be no need for a simplified income inclusion rule. The income of the low tax constituent entity controlled by the partially owned intermediate parent will already be subject to the income inclusion rule at that level of the partially owned intermediate parent. And if necessary, there is also anyways under tax payment rule as a backstop. However, we acknowledge there is one case at least where the simplified income inclusion rule would still act as a complement. It's where the minority investor directly holds a stake in the low tax constituent entity, and there is no partially owned intermediate parent. Then in that case, of course, it doesn't make sense to apply split ownership rule. Or we could also take the opposite stance and consider dropping the split ownership rule and applying the ordinary income inclusion rule to a low tax constituent entity, even if the minority investors hold a significant stake. So a simplified income inclusion rule would apply whenever a minority investor reaches 20% of the economic ownership of the low tax constituent entity. And if there's no minority investor at that level, well, we could say anyways, the minority investors are unlikely to control the low tax or to have the opportunity to exercise control over the low tax constituent entity. And that's why we also suggested that the threshold for the split ownership rule drops from 90% to 80%. And also, if we look at the broader purpose of Pillar 2, it's to achieve minimum global taxation on large M&E groups operations, but not on the income of minor investors in a low tax constituent entity of another group. So we acknowledge that either option of dropping the one or the other rule has some shortcomings, but on the other hand, it would avoid an overlap of complex sets of rules and related computations, depending on whether the controlling M&E has more than 90% or between 80 and 90% or less than 80% in the low tax constituent entity, in which case you also need to look at the size of the minority investor stake. And simplifying is also more relevant in situations where the percentages of ownership fluctuate over time and possibly, well, of course, at some point during a single tax year. The other point that I would like to briefly touch upon is now let's assume we maintain the split ownership rule. Then how do we handle the interaction between the ordinary income inclusion rule and the split ownership rule and the simplification rules proposed, which have been touched upon by the first panels this afternoon. So an idea that we raised, and might not be a perfect idea, certainly not, but it's just to support the discussion, is a move away from jurisdictional blending and to split instead the blending between those entities which would be subject to the income inclusion rule at ultimate parent entity level and those which would be subject to the income inclusion rule at partially owned intermediate parent level. Because, for example, let's assume I have an overall ETR in a jurisdiction which is 9% and my minimum globe ETR is 10%. But let's imagine my 9% jurisdictional ETR is just because on the one hand I have entities controlled by my UPE which have an effective tax rate of 7%, and on the other hand I have other subsidiaries in that same jurisdiction which are subject to the split ownership rule and have an effective tax rate of, say, 11%. And then between 7 and 11, I get to 9%. Well, if I do the split, then I don't need anymore to determine, okay, at which level should I apply my income inclusion rule, at the level of the UPE or of the partially owned intermediate parent. I know I have only one subset of subsidiaries which is problematic, and therefore I apply the income inclusion rule only to that subset of entities, and in my example, these entities which had a tax rate below the, let's say, 10% globe minimum ETR for the sake of the example, were controlled by the UPE, so only the UPE would apply the income inclusion rule, and I would not need to worry about the split ownership rule. Of course, deviating from jurisdictional blending, that has also risks, potentially higher top-up taxation. One way to avoid that could be to cap the top-up tax rate to the difference between the globe ETR and the jurisdictional ETR. But if I do that, then in turn, maybe I cannot use all simplification measures for the group of non-problematic entities in the low tax jurisdiction. So there is a balancing act to be made. I think several participants and also the chairs of the panels have stressed this. Need to find a balance between complexity and accuracy, between compliance costs and increased tax liability. There's no easy answer, and that's why it's also key to listen to the other panelists which represent businesses, because they are the ones who eventually will also be in the front line to apply these rules. Maybe just as a final word, while we were brainstorming to prepare this session internally, then a colleague came up with even a more radical solution, which would make things maybe even simpler. What about having the option to pay additional tax in the low tax constituent entity jurisdiction so as to reach the globe minimum effective tax rate in that jurisdiction as well, and not having to be in the scope of the Pillar 2 rules. That could be also a solution. Probably it would also avoid what I would say is a certain bias of the proposed rules in favor of the head office jurisdictions, which are probably more often than not OECD members, and maybe less in the developing countries. Thank you.
Thank you very much, Pierre-Antoine. I am talking with my video off because I appear to be having some challenges with my connection, and I hope that makes me clearer. But thank you, and I think, as you can see there, a very useful submission from Lorenz and Nerf with some interesting ideas about this particular interaction that takes place between this cluster of rules, the under-tax payment rule, the income inclusion rule dealing with split ownership, and some of the joint associated entity provisions that we have been looking at. It's a very useful technical input that I think will be very useful for the working party in thinking about identifying a most sensible solution that is, as we say, comprehensive, well coordinated, but still operates in a mechanical kind of way that provides for these clear and certain outcomes. If I could turn to the next panelist, Pia Dorfmüller. She's a partner at Dentons in Europe and helped prepare the submission for the International Bar Association. The International Bar Association gave some very useful input on the design of the under-tax payments rule, and I think Pia was going to focus her comments on that area. Over to you, Pia.
Thank you, John. First of all, thank you for the opportunity to participate in the hearing on the Pillar 2 blueprint. I'm very delighted to represent the Taxes Committee on the International Bar Association today. So therefore, I'm talking on behalf of tax experts from around the world, and in particular, our 30-member working group from 14 countries. So you may say we created especially for you our own very small OECD Inclusive Framework. So when it comes to the under-tax payments rule, we are in agreement with most other commentators that the proposal for the UTPR is very complex and to some extent unclear, with significant risks of overlaps with the IRR. So therefore, our comments focused on reducing the complexity, and I can therefore only echo what Pierre-Antoine just said and the others on the first panel. So the design of the UTPR seems overly burdensome and complex, especially as the blueprint says it should only apply in limited situations. So we expect that with high complexity, the likelihood of a timely and worldwide adoption of the Pillar 2 will decrease, which in turn, to be honest, somewhat ironically, will increase the situations where the UTPR will apply, because there would be less UPEs that are resident in our country. So in order to make the proposal, as Martin Greinbaum mentioned yesterday, agreeable, workable, and administrable for both taxpayers and tax administrations, we do have some simplification ideas on the general design of avoiding the overlapping between the UTPR and the IRR. So any possible overlap, and there was one example in 613A where there was an overlap. So we emphasize that any potential overlap between the UTPR and the IRR should be prevented. And ideally, this should be done by really clear, bright line rules. So the anti-overlap rule should address all situations, and where there's a risk that the IRR and the UTPR will apply to either the same profit or same expense, payment, or constituent entity. And regardless of which, and I come to that in a minute, what kind of methods of anti-overlaps we see, we recommend that a variety of, let's say, complex and real-world examples will be included in the final report or in the further OECD guidelines. So to think about what are the options for preventing an overlap, we do see 4. So everyone has, its pros and cons as always, but just something to think about. The first idea would be to expand the scope of the IRR so that IRR taxpayer that only own a minority share must apply the IRR on the entire income. So, and this provided there's no outside minority shareholding, so you would say it's all owned within the group. So the advantage of this option would be there is no overlap. However, it must be reconciled with the arguments regarding the economic capacity of the IRR taxpayer. So we'll be commenting about the idea about cross-charging in a minute. The second alternative would be to limit the application of the UTPR to the extent that constituent entities are fully owned, not partially owned, just 100% owned by non-IRR taxpayers. So what's the benefit of this? This should shift the emphasis of the UTPR to its anti-base erosion purpose. And therefore, we don't have this discussion about the economic capacity of the taxpayer because the UTPR is really limited, or the wording of the blueprint, capped by the domestic covered tax rate. One alternative, third alternative might be that the IRR could be qualified as a covered tax, in particular where there's a UPE direct or indirect interest. And last but not least, to pick up the idea about the credit mechanism, which is included in the blueprint, one may think about introducing an IRR credit carry forward, which could apply if the top-up tax to be allocated on the UTPR exceeds the proportionate IRR that has been paid. So the last option, because it's consistent with the proposal, it really requires the rules to be only altered minimally, and there's further limitation of the UTPR. When it comes to the two-step allocation approach from the IBA Taxes Committee, we agree that the allocation of top-up tax on an aggregate or proportionate basis can really be supported. But there's one remark that on the basis that the second allocation key is intended to operate as a backstop to the first allocation key, which is in the paragraph 478 of the blueprint, then again, we would like to see an anti-overlap rule that should extend both allocation key not to apply to the same payment or expenditure. And again, we would like to see more examples in the report or in further guidelines to clarify the operation of this anti-overlap rule between the two allocation keys. And when you look at the examples in the blueprint, you see that there will be situations where the top-up tax will be or may be allocated in a disproportionate manner. So as a result of that, there will be an economic impact generated as they are suffering from the allocation of top-up tax, whilst they might not be involved in any unwanted base erosion. So think about that you pay to high-tax jurisdictions. So, and this point with the disproportionate manner is in particular important or critical where constituent entities are not 100% owned by the UPE. So when you think about anything that's disproportionate, you think about, how can you solve this situation? So the idea would be that the extra cost would be cross-charged to entities in the group that really generated the liability so the countries that are in low tax constituent entities. And we would appreciate it that draft legislation would propose rules to efficiently allow for this cross-charging. And last but not least, coming here myself from a European country, the allocation of the top-ups tax has to be compatible with EU fundamental freedoms. So accordingly, there are arguments that the allocation mechanism should only be imposed on wholly artificial arrangements. And the ECJ has held that the anti-abuse rules must provide for counter evidence. So even though the UTPR is limited, or wording of the blueprint capped, to the amount of domestic covered tax, the application of the UTPR must be really carefully considered if the deduction of an expenditure has already been denied under a domestic anti-treaty rule, or say anti-base erosion rule. So think about the interest limitation rule under added 1 or other anti-hybrid provisions. So what the UTPR really creates here, it creates an inclusion without any deduction. So how do we solve this? Our idea would be similar with the overlap in the case where there's not deductible payments in reality, that a credit will be provided for the UTPR taxpayer. So to reflect that actually there has been imposed tax and paid taxes, and not to create with the UTPR a double taxation, which is stated in the blueprint that it should not. A couple of remarks on compliance and administration. We really welcome the self-certification system that has been included in the blueprint. But again, we were hoping for further simplification of the process that will come in. So we thought about that a certification should also be made by a very simplified check the box exercise for M&Es to reduce the administrative and the compliance burden as at for businesses. So we would recommend a common standard and process for certification that should apply really for all implementing jurisdictions, such as what Catherine meant on the first panel came up, is the country by country reporting template, just to think about something that is similar. Also, with respect to penalties, we believe that clarification should be provided whether penalties apply where an M&E fails to certify or provides an incorrect or misleading certification. Think about that with the second allocation key, you are required to obtain information from other entities, and to have a penalty that assesses that you are relying on other companies' data is, I think, somewhat, critical when it comes to making a valid certification. Moreover, the interaction of certain certification requirements with the existing exchange of information framework, we would like to have considered and clarified. And the idea or simplification ideas with respect to the certification process, we strongly recommend that there should be enough room to make a simplification that only a single valid certification is required and not multiple as set out in the blueprint, that the certification would not need to be provided by each and single M&E to be valid. So rather that the UPE can make one certification for the entire group. And we would like to see let's say, a master of a certification form to be developed in the implementation process. With respect, and I think I can keep this short, John, the second part, what other, options for streamlining the compliance burden we see? I can echo what has been said on the first panel with respect to harmonize it to the extent possible with existing compliance mechanisms, such as the country-by-country reporting, or also existing transfer pricing documentation obligations. So the idea here would be to also develop a common standard master file for reporting purposes, where you could include the information all, in a master file. Those are the constituent entities. Those are my low tax constituent entities. This is the determination of the top-up tax. And this is the application of the IRR, and this is the application of the UTPR. So to have one master file instead of all, different local filings. So this is it from Frankfurt on behalf of the IBA Taxes Committee. Thank you for the opportunity to speak. And a very special thank you for all the translators for the amazing work today. Thank you so much. Back to you, John.
Thank you very much, Pia, and I think you get a feel for some of the detail and the carefully thought out technical content there in relation to IBA's submission on the undertax payment rule. It's very much appreciated. If I could then just turn to Derek Teurer. One of the key questions we have in the design of the globe is how it can be integrated with an existing global minimum tax, which is of course US GILTI. Number of obvious similarities, but also differences in the design of GILTI and GLOBE that provide us with some interesting challenges in thinking about GILTI coexistence. So, Derek, if I could ask you to speak on those issues.
Thanks, John, and hello. Very pleased to be with you all today. Business Roundtable represents the CEOs of more than 200 of America's leading companies, which collectively employ more than 15 million individuals. And many Business Roundtable member companies have been at the forefront of responding to the global pandemic, whether developing and distributing vaccines and other treatments, producing protective equipment and other critical supplies, maintaining connectivity for businesses, employees, customers, as well as for students. I note that this would include a couple of primary school children in my own home who are at this moment learning remotely from their wonderful teachers. Business Roundtable member companies are committed to beating the virus and helping individuals and communities thrive in the months and years ahead. We applaud the OECD Secretariat, a lot of significant work in recent months in the face of remote work and other challenges. We also appreciate their continued focus on global recovery and economic opportunity for all. Engagement with the business community is just critical to developing solutions here that will be administrable and importantly, durable. And we express our thanks for the chance to share some perspective on Pillar 2. I will endeavor to be concise, mindful of everyone's time. In 2017, the United States passed major tax reform legislation. It included many provisions responsive to the original OECD BEPS project, not least of which were measures consistent with Action 3, designing effective CFC rules. Separate from the existing Subpart F passive income rules in the US, the new Section 951 Cap A, the Global Intangible Low Tax Income, or GILTI, imposed on home country. It imposed a new home country taxation on active business income of CFCs without any industry carve-outs or substance-based exceptions. So 2 key points on GILTI in the context of this Pillar 2 dialogue. 1, GILTI already operates as a rigorous global minimum tax. And 2, Pillar 2 should coexist with the existing GILTI regime. So GILTI as a rigorous global tax on CFC income. While GILTI is applied on an overall basis rather than jurisdictional, the GILTI regime often results in more burdensome results than the income inclusion rule for taxpayers. Why is this the case? A couple of structural attributes to highlight of GILTI. The foreign tax credit haircut, GILTI regime allows only an 80% credit for foreign taxes paid. So under GILTI, so taxes due under GILTI unless the foreign tax rate exceeds 13 1/8%. That's a higher rate than's contemplated under the income inclusion rule top-up tax. In addition, and importantly, expense allocation. The GILTI FTC limitation is further reduced by allocation of the parent's interest and stewardship expenses. In many cases, this will result in tax under GILTI, even where the foreign tax rate exceeds 13 1/8%. And further, excess GILTI foreign tax credits do not carry back or forward. Instead, they are permanently forfeited. Point 2, again, the various rules contemplated under Pillar 2 must coexist with GILTI. As a rigorous global minimum tax, GILTI should be treated as a qualified income inclusion rule under the coexistence principle that was described in the blueprint. Companies subject to GILTI should not be subject to other global rules in its CFC jurisdictions. The GILTI rules are tough. There's a significant compliance burden for both taxpayers and the tax administrator, and it's not feasible to impose an additional complex layer of global minimum tax rules on top of what US companies are already burdened with respect to their CFCs. In short, a GILTI plus model is not acceptable. Many technical details remain to create this coexistence ecosystem, and we look forward to providing additional input in the weeks and months ahead. Again, we commend the OECD and the Inclusive Framework for the hard work and open process. And with that, I'll conclude. Thank you.
Thank you very much, Derek. An important issue that we need to think about as we move towards how this particular system can be made to work in a global and integrated basis. And some interesting times ahead of us in terms of the change in administration in the US, and so we have some interesting dynamic at play there that we'll see how that turns out over the coming year. Finally, in terms of the panelists, I wanted to turn to the subject tax rule. It's a key element in the design of the GLOBE proposal. It's a treaty-based rule, as we've discussed, of particular benefit to source countries, those with lower administrative capacities in particular, and provides them with an ability to protect their tax bases from BEPS structures that rely on the provision of benefits under a treaty. We have two speakers on our panel who are going to talk to you today about the subject tax rule based on their submissions. The first is Natalia Quinones from the Instituto Colombiano de Derecho Tributario, and the second will be Renu Navikar, who is the Global Head of Tax from Tata Consultancy Services. First, I would ask Natalia to speak.
Thank you very much, John. Colombian Tax Institute, Instituto Colombiano de Derecho Tributario, is an academic institution based in Bogota. And on behalf of all our members, I'd like to thank the Secretariat for welcoming a developing country voice.
Sorry, Natalia, I fear we cannot hear you well. If you could change or get closer to the microphone.
Can you hear me now? Sorry, I will use the... Can you hear me now?
It's slightly better if you could speak louder.
Thank you. Can you hear me? Yes?
We can. You need to shout almost, I think.
Sorry for that. Okay, so the Colombian Tax Institute, or Instituto Colombiano de Derecho Tributario, is a Colombian-based academic institution. And on behalf of all our members, I would like to thank the Secretariat for welcoming a developing country voice into the discussion. I've been, as a developing country voice, I've been tasked with the defense of the subject to tax rule. As we saw in the slides earlier this morning, there's been some claims to exclude the subject to tax rule or to postpone its enactment. And I would like to speak in favor of keeping the subject to tax rule and making it effective as quickly as possible. So the reasons for my defense start with taking a bit of a step back. I think all the commentators agree that certainty is a desirable outcome for this project. But we often overlook the importance of stability in creating certainty in the long term. And I think in order to really create stability in the new rules that are being introduced, we need to take care of balancing the distribution of taxing powers between the different types of jurisdictions involved. We've seen from prior speakers, Pierre-Antoine, for example, pointed out that there is a general bias in favor of more developed nations where the ultimate parent entities are located. Colombia, for example, which is not a very large developed nation, has under 20 companies that exceed the 750 million threshold. If we think of other countries in Africa and Latin America, we can definitely see that the income inclusion rule will very rarely bring substantial revenues for them. We know then that the real possibility for these countries to obtain any taxing powers from the new rules would be the subject to tax rule. Definitely, we understand that there are some concerns for over-taxation and for complexity in the application of withholding taxes. The Colombian Tax Institute believes that those concerns can definitely be addressed, mainly by lowering the triggering rate, which has already been done in the blueprint. If there is evidence that it needs to be lowered further, then that is something that can always be done after a trial run. And then also by creating the annualized ex post charge instead of the single real-time withholdings, which would be very difficult to apply for every withholding agent. We also want to point out to the fact that the subject to tax rule requires a multilateral treaty, or at least the renegotiation of existing tax treaties by developing countries, which also makes it more difficult for developing countries to access the benefits of the GLOBE and the general BEPS 2.0 project. So in this sense, excluding it completely would even put them in a worse position that I think would definitely challenge the stability of the rules in the long run. As to the rationale of the rules, I would also like to point out that we need to be consistent across all of the rules. It is not very consistent to say that the rationale for the GLOBE project in general is to create minimum taxation, while the rationale for the subject to tax rule is to address high-risk BEPS payments. I think the rationale should be the same for all of the rules. So the rationale for the subject to tax rule should also be to prevent any income from being undertaxed in low tax jurisdictions or in very specific special regimes created for specific projects. Given this framework, I think that the covered payments in the subject to tax rule can be broadened to be consistent with this general objective of avoiding low taxation, regardless of whether the income comes from a payment that represents a low return or a high BEPS risk. Also, on the low return exclusion, we should ask ourselves if the rationale is that income arising from low return activities can remain untaxed. I mean, is that the outcome that we're pursuing? And if it is, then definitely the low return exclusion should apply to every other rule. the income inclusion rule and the under-tax payments rule as well. But if that's not the outcome that we're trying to pursue, then I don't see why we would allow such exclusion for the subject to tax rule. It's also important for us to mention that the materiality threshold should definitely reflect the circumstances of each market. And I cannot emphasize enough on this. Markets are very different. After the pandemic, there's been very severe currency devaluations happening in many developing countries, and thus having a decision of what is material or what is not material has to be made in the context of that specific market. Finally, I would also like to point out that anti-fragmentation rules should be taken into account if the materiality threshold is to be introduced. This is obviously to prevent the avoidance of the subject to tax rule. So again, I think if we want stability in the long run, we need to give developing countries a possibility of benefiting from these rules. We've seen also from Pia, who just spoke, that the under-tax payments rule will very seldomly be used. We've also seen claims earlier today for postponing the application of the under-tax payments rule until every country has adopted their income inclusion rule. So in the end, all that's left for the developing world is the subject to tax rule. So we strongly encourage the Inclusive Framework and the Secretariat to continue to pursue this rule and to continue to address the concerns of business, which I think can definitely be addressed in the ways that the Secretariat has already been thinking and including possible ways to address them in the blueprint, such as the annualized ex post charge. And again, if we do a test run or a trial run, we can definitely see if there is double taxation or over taxation happening with the annualized charge. And there can be a monitoring process within the OECD to ensure that these ex post charges do not represent double taxation for businesses. I think this is what we mostly want to say on behalf of the Colombian Tax Institute. I think later on we're hearing from Sol Picciotto on the minimum effective tax rate, which we also think would be a very interesting solution for developing countries in case the subject to tax rule were to be dropped. Thank you very much, John.
And thank you, Natalia, for your input and your insights into the subject of tax rule. Very valuable. If I could ask Renu Navika as well, who made a submission on behalf of Tata Consulting, who also had some views, perhaps some slightly different views on the appropriate role and scope of the subject to tax rule. But Renu, over to you.
Yeah, thank you, John. At the outset, we at Tata Consultancy Services would like to thank the OECD for giving us this opportunity to input into this very important policy making. We also want to commend the members of the Inclusive Framework for the detailed technical framework on both Pillar 1 and Pillar 2, and the focus on the need for tax certainty and avoiding double taxation. Now, coming to the topic of the subject to tax rule, I think the premise behind the STTR is very simple. Namely, where a jurisdiction does not exercise its taxing rights over the receipt of certain payments to an adequate extent, the jurisdiction of the payer has a right to claw back those taxing rights, negating in part the relief it allows for the deduction of the payment for local tax purposes. Unlike the IIR and the UTPR, the subject to tax rule is not concerned with the ETR. Instead, it looks to nominal tax rate that applies to certain payments between connected persons. The blueprint gives priority to the subject to tax rule, which is to be applied to source countries on intergroup payments, where the receipt is not subject to a minimum level of tax based on an adjusted nominal rate. The STTR would help source countries protect the tax base by denying treaty benefits for deductible intergroup payments made to jurisdictions with either low or no taxation. It would catch payments like interest, royalty, franchise fees, insurance, reinsurance premiums, guarantee fees, financing fees that present a high risk of profit shifting to low tax jurisdiction. The rule is proposed to be applied on a payment-by-payment basis, but may be calculated and administered by way of an annual return. Now, I heard Natalia before me, and I understand where she's coming from. But with this background to the STTR, we do see some challenges to this the rule. Firstly, I think applying this rule on a payment-by-payment basis is likely to be problematic from a practical perspective. Secondly, application of STTR on a transaction-by-transaction basis will not allow for blending. Also, applying an appropriate minimum tax rate to gross payments is likely to be challenging where the gross amount is not reflective of the net profit arising in the low tax country. That is to say, the STTR minimum rate at the gross level versus the globe minimum tax at the net level. So for example, if the globe minimum tax rate determined under the globe rule is say 15%, and the STTR rate is say 5%, and the MNE's profitability is 10%, then an STTR at a 5% will be higher than the globe at a gross level, which is 15% of 10%, which is 1.5%. Another challenge is the fact that implementation of STTR, it requires significant amount of information, namely value of transaction, taxability of payments in the payee jurisdiction, bifurcation of payments subject to STTR and not subject to STTR. Now, all of this information may not be available during the financial year to which the income pertains. It would be almost impossible for the taxpayer to gather all the required information and recover STTR top-up tax in the form of withholding. Now, there could be two potential approaches to address this issue, but they also have their own limitations. The first is determination of threshold based on past year or average data. However, this could result in an over or under withholding. The second could be withholding after the end of the year. This would, however, result in delaying the globe tax liability computation, as STTR would be a vital input for the same. Although the intention of the STTR is not to reallocate taxing rights, taxing all payments connected to mobile, capital, assets, risk, presuming that they erode base, can potentially increase tax dispute between the source and the resident jurisdiction over taxing rights. For example, provision of guarantees is a corporate function, value of which is linked to asset base, reputation of payee, and not derived from the source jurisdiction. Similarly, in the case of a marketing or agency services payment, it would not be correct to say that in all cases, the intangibles such as customer lists, etc. are developed by the payer. In many cases, the same could also be developed and maintained by the payee also. Thus, withholding tax on such payments would actually be against the underlying principle of taxation. And I think most importantly, business would wish to ensure that profits are taxed only once and that there's an effective and timely resolution of disputes between countries on the application of the subject to tax rule. As I mentioned earlier, the intended functioning of the STTR is not to reallocate taxing rights between jurisdictions, but to allow source jurisdictions to apply a top-up tax in relation to base eroding payments. The point to note here is that with the introduction of Pillar 2, MNE's global income will be taxed at a minimum tax rate through the globe rules, that is the IIR, the UTPR, and the switchover rule. So there may not be any motive for an MNE to actually indulge in base erosion activities. Further, with the MLI, the countries have already agreed to bring in treaty abuse provision, such as the principal purpose test, the LOB provisions, and the beneficial ownership clause. These provisions, we feel, should sufficiently address the BEPS risk. Introduction of STTR will only add complexity and overlap with the other anti-abuse provisions. Accordingly, we believe that globally implemented IIR at the parent level should be sufficient to address the BEPS risk, and therefore there should be no need for implementation of the STTR currently. However, if at all we go with the view that STTR needs to be introduced, it needs to be simplified, and we do have a few recommendations on this account. The first recommendation is that there should be an exclusion for low return payments. That is, only payments which derive value from the payer jurisdiction should be subject to STTR. Secondly, detailed guidelines on covered payments, that is a positive list, negative list, the threshold applicability, the administration, etc., shall be provided. So if the STTR is included in the final proposal, then our recommendation is to keep the STTR rate variable depending on the blended profitability of the multinational in the pay jurisdiction. That is to say, the global minimal tax rate multiplied by the M&E's profitability in the pay jurisdiction. So in the previous example, if I have to take the global minimum tax rate under the globe rule is say 15%, and the M&E profitability in the pay jurisdiction is say 10%, then the STTR rate should be 15% of 10%, which is 1.5%. This would limit the risk of over or under withholding to a great extent. In any case, it is recommended that both the trigger rate and the top-up tax under the STTR be limited to a rate that is lower than the minimum effective tax rate set under the IIR and the UTPR in order to limit the risk of overtaxation. Next, I suggested in the blueprint, we also agree that the STTR should be implemented by way of an ex-post annualized charge, which shall be complemented by a certification system which is lower or no withholding certificate. This will ease administration burden on both the taxpayer and the tax administration. If the STTR for whatever reason is not implemented by way of an ex-post annualized charge, then as a second best option, we recommend a low interim withholding with balancing payment to be implemented. This would be the most balanced method proposed for taxpayers and tax administrations in terms of the cash flows. It also has the greatest degree of predictability of liabilities due to the ascertainable nominal rates of taxation. Finally, because it is based on a lower rate of withholding, it minimizes the impact of an over withholding on payment situation that can arise when a payment is initially thought to be within the scope of the STTR, but after and post examination of the facts is found not to be within the scope. In terms of the threshold from the suggested three options, that is the M&E size, the tiered value of covered payments, and based on ratio of covered payments to the payer's total expenditure for threshold, our recommendation is that the threshold based on ratio of covered payment, that is per pay jurisdiction to the payer's total expenditure, be adopted, as it would reflect the risk of base eroding payments. Interest limitation implemented in various jurisdictions, somewhat similar to the US BEPS. Last but not the least, we would like to conclude by saying that if the STTR is implemented, it should have a narrow scope with defined criteria that avoids ambiguity, potential controversy, and prospective litigation. Thank you very much once again for this opportunity. Over to you, John.
Thank you very much, Renu. And look, I thought that was a very thorough analysis of the STTR, and I'm particularly interested in your suggestion about how we might go about calculating the appropriate level of withholding tax based on the profitability of the counterparty. But there are some interesting ideas there, and obviously further work to be done. This is a topic that is under active discussion in the working parties, and we look to be making good progress. So that is encouraging. Taking on board many of the design suggestions that have been made about making this rule as administrable and targeted and certain as possible for taxpayers in the context of these overall rules. That concludes the panel part of the session, but we had two further interventions that we were seeking from the floor on this question. The first one is from Monica Winneman. She's the head of the Department of Tax and Financial Policy for BDI, which is the Federation of German Industries. And after that, we'll hear from Sol Picciotto. But first over to Monica for some interventions, primarily focused on rule coordination and implementation.
Thanks, John. And first of all, thank you for the invitation and certainly for giving me the opportunity to present the point of view of the German industries. I'm very pleased on virtually being here with you. I represent the BDI, who is the leading organization of German industries with more than 100,000 companies. German industry welcomes and recognizes the progress that has been made on the technical development of both Pillar 1 and 2. At the same time, we would like to point out that some of the proposed solutions are lacking a fair degree of pragmatism, and the implementation in practice will create high challenges for the companies. Before addressing the topic of implementation and rule coordination, please allow me to make one general remark. We are concerned that the amount of work needed to implement the proposals for both tax authorities and taxpayers may be relatively high compared to the expended revenue gains. This is why we want to stress that both proposals have to be simplified significantly. This must also include, at first, further improvements regarding increased tax certainty, and second, means to avoid digitalisation. Regarding Pillar 2, we have to point out the complexity associated with the new provision under Pillar 2. Especially, the interaction with existing international and domestic provisions increases complexity. Businesses are concerned that the interaction of the under-tax payment rule with the income inclusion rules on the one side, as well as possible CFC rules and the provisions under Pillar 1 on the other side, can hardly be managed. Therefore, a global coordination of the application of Pillar 2 will be a very challenging task for business. This is, in part, a result of the corresponding documentation requirements. When it comes to the implementation of the global rules, their implementations requires different approaches. The income inclusion rule and the under-tax payment rule do not require changes to bilateral treaties. They can be implemented simply by changing domestic law. This does not apply to the subject to tax rule and the switchover rule. They require amendments to bilateral treaties or an implementation through a multilateral instrument. In this case, the OECD should focus on providing tax certainty and eliminate double taxation. This can be achieved by effective dispute prevention and proper resolution mechanism. A multilateral instrument allows jurisdictions to swiftly implement the new measures and offers concrete solutions for governments to close gaps in existing international tax rules. Thereby, the results from the OECD G20 BEPS project could be transformed into bilateral tax treaties worldwide. A new MLI could be used to coordinate the application and operation of the rules in a legally binding form, thereby providing for more tax certainty. From an industry point of view, such a global rule coordination within Pillar 2 is essential. Otherwise, a lack of rule coordination can easily lead to double or multiple taxation. In our position paper, as the Federation of German Industries, we also suggest the introduction of a whitelist of countries with existing acceptable income inclusion regimes or countries which will introduce the income inclusion rule. As you know, for example, the Pillar 2 print indicates that guilty should be considered as a compliant regime for purposes of the income inclusion rule. Such a whitelist would be an important and easily achievable way to simplify the provisions under Pillar 2. Whitelisting existing income inclusion regimes also supports the underlying policy rationale of Pillar 2. Without introducing such a whitelist, each business would have to check individually whether the income inclusion regulations of a specific country are in line with the regulations of Pillar 2, which result in bureaucratic burden for business that could easily be minimized. Thanks again for giving me the opportunity to share my comments with you.
Thank you very much, Monica, and useful, I think, to have that input. Finally, we have specifically requested intervention from Sol Picciotto from the BEPS monitoring group, which has always played an important role in shaping the policy debate, really from right throughout the BEPS project, but now as we start to address the tax challenges of the digital economy, his interventions always provide us with some good insight and perspective. So I'd like to hand the floor to Sol to be the last contributor to this panel discussion. Sol.
Many thanks, and thanks for the opportunity to contribute on behalf of the BEPS Monitoring Group. For those who don't know us, we're a network of international tax researchers in many countries, independent of both governments and business. we try to help bridge the what Pierre Habard yesterday referred to as the regrettably large gap between technical experts in international tax and the wider public, which obviously has become increasingly aware and concerned about the problems of international tax. So we commend the OECD Secretariat, like many of the other commentators, on the enormous work that's gone into this blueprint. They do provide, in our view, many of the key building blocks for potential solutions, regardless of what actually comes out of the current package of proposals. Now, although many of the contributions, especially yesterday, I think expressed optimism, I think perhaps this was more in hope than in expectation, especially as regards Pillar 1. It seems to us there are considerable problems with it, and it entails an enormous administrative apparatus to deal with rather a small proportion of, by the OECD's own estimates, of the amounts of misallocated profits. But Pillar 2, the concept of a global minimum tax, offers a better road for an effective, promising solution. According to the impact assessment also, it would be more effective and more beneficial. But regrettably, the blueprint, although it does include very important key building blocks, the package, it seems to us, is not acceptable and unworkable in any case. And the basic problem is, as we've been hearing today, the difficulty of coordinating the application of the rules. The priority given to the income inclusion rule is clearly inequitable. If the income inclusion rule is modelled in any case on CFC rules, which of course has existed a long time, and which actually give the source country a prior right to tax. So the idea that the similar approach would be adopted but somehow prevent a prior right by source countries seems inequitable but also unworkable. So the package proposes to include a third rule, a subject to tax rule with basically withholding taxes. And we've heard a lot in the from the panelists about the problems that this would create from the point of view of business, but also I think from the point of view of tax administrations, those kinds of taxes are difficult to apply because they need cooperation from the conduit jurisdiction often, which isn't always forthcoming. But most important, the whole package would require a comprehensive multilateral convention signed and ratified with no opt-outs or reservations, unlike the multilateral instrument, which we've already had. This would need to be signed and ratified with no opt-outs or reservations, effectively by all states. That will be needed to allow the STTR, also the switchover rule, but also to enforce the priority of the income inclusion rule. Now, many have supported, given strong support for a multilateral convention, but that in effect would be tantamount to saying that this proposal would never be implemented. It seems impossible to conceive that such a multilateral convention could be achieved. Now, if we go back to the blueprint, it rightly explains that both the income inclusion rule and the under-tax payment rule can be applied without changes to tax treaty rules, as Monica Wuneman just explained. In fact, they're modelled on the GILTI and the BEAT, which the US adopted unilaterally, as has already been pointed out also. And in fact, the BEAT is a source-based protection rule, and the US isn't the only country that's done that. My own country, the UK, but also followed by Australia, enacted the diverted profits tax, which also is a source-based protection rule. Now, the Inclusive Framework has asked that the US should consider not applying the BEAT in relation to income in countries which apply the IIR, but you know, there may be such countries, since they would benefit from applying the IIR, would be willing to. But why would source countries, which really would get little or nothing from an IIR, agree to give priority to the IIR? It just seems that the coordination problem cannot effectively be resolved. So to that end, we've put forward in our submission, and we've provided an outline in the BEPS Monitoring Group submission, but we're going to publish a paper with some other colleagues shortly explaining it in more detail. This is a proposal for a minimum effective tax rate, the METR. Now, it would use the same methodology as the Pillar 2 blueprint in the first stages for calculating the effective tax rate, with whatever improvements result from this consultation and other discussions. But the next step would be a method for calculating the proportion of the undertaxed profits that have not been effectively taxed at the minimum rate. So these would be profits reported in countries with an ETR below the minimum. They would be multiplied by the quotient of the difference between the minimum and the actual ETR divided by the minimum ETR. So this takes out those parts of the undertaxed profits that have effectively not been taxed at the minimum ETR. It would then apply a substance-based allocation rule. So instead of having the carve-out, the substance-based carve-out, a substance-based rule would be used to allocate these not effectively taxed profits amongst all the countries where the company, the multinational, has a taxable presence. And there, each country could apply its own standard tax rate. So even countries with an ETR below the minimum would still get their allocation, and they could still apply if they wished their rate below the minimum rate. But equally, countries with a rate above the minimum would apply and could apply their own normal rate. So this would provide parity between the undertaxed profits of companies doing business in the country with purely domestic companies. And so it uses a substance-based rule to resolve the issue of allocation. The substance-based rule would be a 3-factor rule, not just the 2-factor rule proposed in the carve-out, but we would add sales revenues to assets and personnel. So the methodology in the blueprint in Chapter 4 for the payroll costs and tangible assets could be used for quantifying those factors. And for sales revenues, the methodology could be used from Pillar 1. Pillar 1 has developed detailed sourcing rules for sales revenues, taking account of both customers and users. So that methodology could be used for this 3rd factor in our substance rule. Some further work would be needed since Pillar 1 doesn't cover business services, but essentially the building blocks are there. Now the advantages, the key advantage, well, many advantages of the meter, but they allow all countries, both residents and source, to apply the same allocation rules simultaneously to determine their share of the not effectively taxed profits. So there would be no need to manage these complex coordination problems that we've been hearing about this afternoon, and that would obviously greatly simplify the proposal. So there would be no discrimination. Countries would apply this to both inbound and outbound investment with no discrimination. And there would be no discrimination between MNEs and purely national firms, since the same tax rates would apply. So that would make it more compatible with any non-discrimination rules which often exist both at national level in constitutions, at regional level obviously in the EU, and sometimes in international or in trade and investment treaties. The same methodology would be used for actually levying the top-up tax as for the IIR and the UTPR in the blue. So that would ensure compatibility with tax treaty rules. So that would mean that there would be no need for treaty changes to implement our proposal. Although obviously it would be desirable to ensure that a switchover to be implemented quickly by all states willing to do so. This would provide a balanced allocation of rights to tax undertaxed profits, so it would be much more acceptable to a wide group of states, sufficient, we expect, to provide a critical mass. So we would urge the OECD to throw its weight behind this approach to ensure that it could be implemented quickly and that it could be properly coordinated. Thank you very much.
Thank you, Sol. And I think about and he has obviously one of the significant challenges here, as we've touched on in this part of the panel presentation, is achieving a measure of consensus around these allocation keys and where the tax liabilities should arise and in what jurisdictions. And there's a combination of factors there, both political and pragmatic, that can make some of these decision points very challenging indeed. I think it is worth pointing out, perhaps echoing one of the comments that Jesse made in the previous panel when he was describing his expects to what these type of rules are brought environment. One could well find oneself in a situation where these rules are operating as a background that informs the architecture of the tax system itself, and leads us to change of behaviours, both in terms of local tax collection and M&E behaviour, such that in practice, in many cases, these rules do not impose a positive tax charge because other tax rules and other structures are in place that are subject to higher rates of effective taxation, which creates the problem, as Jesse was identifying, that you now have introduced an infrastructure to tax, which isn't creating a tax obligation itself, but merely forming part of the background under other rules. So I think that's an important factor to bear in mind, and one that we need to bear in mind as we go forward and think about the design of these rules, is that need to be designed in practice on a dynamic basis that takes into account the economic impact assessment that was done in relation to the potential economic impact two proposals. Look, we don't have a lot of time, so we unfortunately won't have time to go through some of the questions that have been provided in the chat. We will take those questions, of course, on board, factor them into our thinking, and we may reach out to you after the session to speak to you directly on the points you've raised. I would like to thank the panelists for their contributions, both written and oral, and also all others that public consultation. Now some insights into some, but by no means all the ideas that have been raised in the public consultation. And I will hand back to Marco just to close the session. And then finally, Pascal has, I think, some closing words for us. So over to you, Marco.
Yes, thank you. Thank you very much, John. Thanks also to all the panelists and discussants. That the discussion was very valuable and indeed useful inputs for the forthcoming discussion, in particular in the Working Party 11, but also for the inclusive framework. Without trying to summarize, all the message that has been raised, there are a clear message on the need for simplification and reduced complexity, to consider specific rules for different rules, maybe on the timing differences, maybe reconsidering the approach on carry forward that has been included in the blueprint, and also consider specificity of some industries for which there can be, in particular for capital intensive industries, which can be particularly challenge the rule as designed so far. On the subject of tax, of course, we had a long discussion in the working parties on all this issue, but of course we will duly consider in the forthcoming discussion. Important in particular for developing countries, but on the other hand, need to limit and reduce the overtaxation. So this is duly noted. I thanks all for the contribution, and let me just give the floor to Pascal in order to summarize this 2 days of consultation. Pascal.
Marco, thank you very much, and good whatever to you all for today, as it's the first time I speak. So I would first like to thank you all very much for this public consultation, for all the comments you sent, for the interest which has been showed, for the speakers. We had, I think, more than 3,000 people overall listening in through the Zoom or through the OECD TV channel. That shows the interest. That also shows that there are different views, that they are among the business, among the NGOs, among the academics, trade union, BIAC, quite diverse views, not necessarily convergence or because of this diversity and the confrontation that we may be able to make progress. Will we make progress? I don't know, we'll see. There are many comments pointing to in terms of scope on Pillar 1, in terms of complexity on both pillars, in terms of need for coordination, but we could also see the glass half full, because overall what I hear from everybody is there is a need, one, to update the international tax system. We haven't heard anyone say, oh, it's perfect, let's not touch it, which is a change. I mean, 8 years ago when we started BEPS, I think the main line, except for Seoul probably and a few others, the main line was to say, don't change anything, while today there is the acknowledgement that something needs to be done, but something which would respect some form of fairness and simplicity and good coordination. So in that sense, I think we can be optimistic. And finally, I have to say, your job is to comment on the draft, not to draft yourself a solution. It's the job of the governments, it's the job of the delegates with the support of the Secretariat to try to come to a solution. The main takeaways for me will be, of course, the discussion on how we can yesterday, I think, by Martin, but on in particular double taxation, and we have this pending issue of the scope, which is largely related to the policy rationale of a change. Rahim and John have brilliantly concluded, so not much to add, except maybe the emphasis on the need to enhancing coordination of the rules, and that's our job, and we're extremely sensitive. You know that on Pillar 2, countries can move on their own. They don't need us. They don't need the OECD. They need the OECD, the inclusive framework, and being all together, because precisely there is a need for I think we've discussed, we have seen the appetite for simplified administrative measures. They may raise some political challenges, but all that is well noted. Maybe the last word would be to thank you, just to say because I was following on Twitter, and there were some quite funny comments or interesting comments, and the tax Twitter family is quite fun, and I appreciate that, including wondering whether Jesse Eggett, who was grateful to wear a tie, a jacket, some wondered what else he wore and whether there were trousers or not. So that's the level of tax Twitter, but it's also good in difficult conversation. I was also struck by some comments who say, how inclusive is this? I mean, you just have big law firms speaking. I think this is probably a misunderstanding of what a public consultation is about. Public consultation is about the inclusive framework members to listen in the conversation and to hear from the public, and the public speaking is based on the contributions we have received. The users, the taxpayers who are users of the norms, and also TUAC or the NGOs, and in particular the NGOs. I can see Saul's picture. Little resources and all the investment they make is very much appreciated. So I think the inclusivity is here. Finally, next steps. Not ignore it. We are working on this. We started working when we had the first comments in, and we anticipated a number of comments because we talked to all of you, whether NGOs, business advisors or so. We'll try to work this out. We have the task force on the digital economy for Pillar 1. We have working party 11 for Pillar 2. So the delegates will exchange. This will be also discussed at the ministerial level at the inclusive framework in 10 days' time. So I invite you all to join the inclusive framework plenary session, which will be public for most of its sessions. And we have a good panel of impressive ministers who will be talking about the next steps. And then Marco is the chair of Working Party 11, but he's also belonging to Italy, which is chairing the G20, the first finance ministers meeting at the end of February. May see this on the agenda. I know it will be on the agenda, and we'll see how things move forward, knowing that we have a strict deadline, which is mid-21. So thanking you for your contributions, thanking you for your ongoing support, thanking you for bearing with us and the complexity of the rules we are trying to come up with, even though we'll put efforts in simplifying them. Thank you very much, and looking forward to interacting further with you at the Inclusive Framework meeting, and then in the course of the year, definitely through Tax Talks and other channels. So thanks to the team also which prepared this, and looking forward to seeing you in person one day not too far from now. Thank you, and have a good weekend. Thanks God, it's Friday.